Friends, welcome to the channel JIB and CIB Made Simple. In this particular video, we are going to cover top 200 MCQs with proper explanation for AML and KYC certification program conducted by IIBF. I will provide you basically memory-based paper which have appeared in the year 2025 starting from February till November, and I will explain each and every question, each and every option, and some maximum questions concepts are repeated from this question which we are going to discuss here. I request you all to treat this as a mock test, give it as a mock test, first try the question on your own and then see the explanation. And if you want complete question bank for AML and KYC, you can WhatsApp me on this particular number. And for more detail, there is a concise notes as well as unit-wise theory, unit-wise MCQs also available. For more detail, you can check the description section of the video. I have uploaded the AML and KYC course through which will guide you to clear the examination in the detected suspicious transaction. They have clearly mentioned that the bank internal monitoring system, they detected a suspicious transaction. So the PO checked all the documents on Tuesday, October 12th. The PO confirmed that it is the case of money laundering. Right. So the bank internal monitoring system flags a series of complex transactions, and after a thorough review of the document, the PO confirmed that the money laundering has happened on Tuesday at 12th October. So here the word confirmed is very much important. Confirm word is very much important. So the question is, which of the following statement best describe the principal officer's subsequent obligation? Option they have given that option A, they must report the transaction to the RBI immediately, followed by a report to FIU-IND within 30 days. Option number B says that they must submit a STR or suspicious transaction report to the director FIU-IND no later than 21st October. Option number C, they say that they must wait for the client to provide a justification for the transaction before deciding whether to culminate the case at their office. And option number D say they must report the case to FIU-IND in a customized bank-specific format within the 7 calendar day. So these are the 4 options that they have provided, and you have to choose the correct answer. Please pause the video now, think about the answer, and then listen to my explanation. I hope you must have done it. Now let me explain what is the basic. So friends, let's understand this question like a real life banking situation. So bank internal system, they detected some suspicious transaction. Okay. Now the PO checked all the document. PO checked the document on Tuesday, October 12th. The PO confirmed that it is a case of money laundering. So once suspicious is confirmed, the clock start ticking. So as per the PMLA guideline, once suspicious is confirmed, this is the keyword to note. When you have confirmed the suspicious, right, the principal officer must report it within the 7 working day. Please note it down. Very important thing to remember. The principal officer must report it within the 7 working days. See, I'm not talking about calendar day. I'm not talking about the calendar day. I'm also not talking after the customer explanation. No need to take. See, I'm not talking about the day when the customer give explanation. I'm also not talking about the RBI approval. What I'm talking about, 7 working day. Now let's compute the timeline. So day count. So first of all, this happened on 12th. So day number 1. Actually, let me draw a timeline here. So 13, day number 1. 14th, day number 2, which is the 13th Thursday. So 13 is Wednesday. 14 is Thursday. 15th is Friday. Right. So this is day number 3. You skip Saturday and Sunday. Why? Because these are non-working day. I'm just concerned with the working day only. Okay, so then comes the day number 4, which is so 16th and 17th we have skipped. 18th is day number 4, right? 19th, so 18th become Monday, 19th become Tuesday, which is day number 5. 20th is Wednesday, which is day number 6, and day 7. Yes, so you see, I told you 7 working day. So day 7 is 21st, and 21st, this is Thursday. Right. So the last reporting days is 21st October, which is Thursday. And now I hope this is clear. 7 working day, how it is calculated, I have just told you. Now, to whom the report should be sent? So remember, the report should be sent to Director FIU-IND. The report has to be sent to Financial Intelligence Unit India, Director, not RBI, not internal office, not customer. Now let's see the option that they have provided. Option number A says that they should report to the FIU-IND within 30 days, and they must report the transaction to the RBI immediately. This is wrong. Please remember that this is a case of STR. and STR they are reported only to FIU IND. RBI is a regulator, not a STR recipient, right? RBI has nothing to do with receiving the STR. What about option C? They must wait for the client to provide a justification for their transaction. Actually, this option is talking about the wait for the client justification. Totally wrong. Once PO confirm the suspicion, once the principal officer confirm the suspicion, no customer explanation is needed. PO is the final authority. So now you know the obligation of the PO, right? Who is the final authority? The principal officer is the final authority to decide that yes, this particular transaction is indeed a suspicion one, right? So no need to waiting for the customer justification. C is wrong. What about D? Customized bank format within 7 calendar day. See, again, double mistake is there. So first of all, the format is not customized bank specific format. Actually, this is FIU IND format. First of all, please remember the format is FIU IND format, and please remember it should not be 7 calendar day. This is another thing to note, right? 7 calendar day, no, it is 7 working day, right? Please remember. So the correct answer is option number P. Why? Because it says that they must submit a suspicious transaction report to the director FIU IND not lesser than 21st October. Yes, we have assumed that no public holiday in between. This is what we have assumed. So question option number B captures the entire detail, right? So I hope this is crystal clear. So there is a trick you can use to remember the rule. This trick you can use 7WF or 7FW. Just let me erase it. Just wait a minute. Yeah, you can remember it like this, 7FW. So when I say 7, it means what? 7 working days, right? 7 means 7 working days. F means FIU IND, and W means when suspicion is final. W means what? When suspicion is final, right? That is the point. So STR is fine only after suspicious is confirmed. Timeline is 7 working day, and report goes to whom? Report goes to director FIU IND. Principal officer is the single point decision maker. No need to wait for customer explanation once it is confirmed. I hope till now everything is crystal clear. Now let's switch our focus to the question number 2. What the question number 2 says, let's have a look. It says that in the context of AML compliance, why are trust accounts subjected to strict documentation, and who are the primary subject of this verification process according to the guidelines? So this is our question. So option they have given that trusts are used for tax exemptions, and therefore the bank must primarily verify the identity of the beneficiary who received the disbursement. Option number B, trusts are frequently used by criminal to mask the origin of illicit fund. Hence the bank must verify the identities of the grantor, settler and trustee. Option number C, trusts are considered low risk entities. Strict documentation is only required when the total value of the fund exceeds a specific regulatory threshold. Option number D, due diligence is primarily focused on the trust physical location and its registered address to ensure that it is not a sell entity. So basically they have provided you these 4 options, and you have to tell me which one is correct. I again request friends, before continuing to the answer of this question, let me tell you through our certification examination in AML KYC. If you are looking for one-stop solution for the entire theory, entire MCQs portion, you can check out our course. In this course you will get separate folder for theory, MCQs, previous year question, quick revision session. In the theory portion, it has been divided into part A, part B and annexer. Everything has been taken from your basic Macmillan book, which is prescribed by IIBF. So you can check out the detail. Inside each part you will get unit wise bifurcation. Like in unit 1 you get theories, MCQs, PDF separately. Similarly unit 2, this is the theory portion. This is the theory part. Similarly, we have unit wise MCQs part, right? And then previous year question. You can check out the previous year, all the 2025 memory based question which has been recollected by the many aspirant, and this is available at very nominal price. You can either WhatsApp me on the number shown on the screen or check out the description. One person give money, right? One person give money and another person manage money. One person give money, and what another person does, he manage the money, right? So, and someone else may benefit from it. Some third party is there who is getting benefited from it. Fine. So because of this layering, the trust can easily hide who actually own or control the money. This is called, layering. See, one person is giving the money, another person is managing the money, and someone else may get benefit from it. So because of this layering, there is a high chance, right, of, because of this layer of hiding, there is a high chance of hiding who actually own or control the money, right? So high chance of hiding the who actually control or own the money. Now that's why strict documentation is required. Documentation should be strict. According to the AML guideline, trust is a popular vehicle, right, used by criminal to hide identity and source of illegal money. So bank treat the trust like, very high risk. Bank treat the trust as, a very high risk account. Criminal can use trust to hide the real owner of the fund. Yes, trust can be used to hide the real owner of the fund. Create multiple layer. Yes, they create multiple layers. And to avoid the normal identification checks. That is why, extra documentation is compulsory. Now the question is, who must be verified by the bank? So, AML focus on two questions. What are the two questions? That who gave money? The first question is, who gave money? And the second question is, who control money? AML focus on these two questions, right? So bank must verify the grantor, right? Who should bank verify? So bank must verify the grantor. Either you call it grantor or you call it the settler, which means people who contribute or settle money into the trust. They are the source of fund. They are the source of fund. And bank must verify the trustee. Trustee means what? The people who manage and control the trust. Someone who manage, someone who control the trust. They control how and where the money moves. So these are the real power holder or AML. So AML must focus on them. Now if you look at the option that they have provided, see option number A. They are talking that trust are used for tax exemption. Therefore bank must primarily verify. Actually, verify beneficiary mainly for tax reason. This is wrong. AML is not about tax planning. Beneficiary may receive money but do not control it. Control and source are more important than benefit, right? What matter more is the control and well as the source, right? Rather than benefits. Option A is wrong. What about option C? Trust are considered low risk entity. Strict documentation is only required when the total value of fund exceeds a specific threshold. Actually, this statement is wrong. It is not a low risk entity. Trust are considered very high risk. They are high risk entity, right? That's why strict documentation is required. Completely C number is wrong. What about D? D says that focus only on physical location and its registered address. No. Actually, AML is all about people. AML is all about people. AML is not about the building, right? So address alone does not reveal who own or control the money. That's why D is wrong. So the correct answer is option number B. Option B is the correct answer. So it says that they are frequently used by criminal to mask the origin of illicit fund. Hence the bank must verify the identity of the grantor, settler and the trustee. These are the three parties who are involved. Fine. So option number B is correct. See, let me tell you a trick to remember all these stakeholders of the trust. First one is the GT rule. That's called GT rule. What does the GT rule say? So G for grant money, right? Sorry, G means G means give money. So when I say G means what? G means gives money. Gives money. Who gives money? Obviously grantor is someone who gives money, right? And T, control money, right? Control money. So who control money? Someone who control money is called trustee. So in trust AML, follow the money and control. So what we learned from this discussion is that trust are very high risk in AML, right? And used to make ownership as well as a source of fund. So bank must identify who gave the money. So bank must identify who gave. Who is the grantor? Who is the settler? Bank must identify. And bank must identify who controlled the money. Who is the trustee, right? So beneficiaries are not the primary AML focus. Now have a look at the next question. See, this is the type of case study type question. Exactly such questions are being asked in the examination right now in these days. So that's why I have included the case study type question also for your practice purpose. Question is, bank automated monitoring system flag a new current account opened 4 months ago. The account belonged to a local jewelry exporter who has recently been elected as a member of Legislative Assembly, MLA. So the question is, according to the guidelines and RBI risk-based approach, which combination of factors necessitate the high risk categorization and what is the specific operational consequence? So option A says that the account vintage under 6 months and the cash intensive nature of the jewelry business, the bank must update KYC every 5 years. Option number 3 says that the customer status as a politically exposed person and the business sector, the bank must conduct KYC review every 2 years. Option C says that the complexity of the beneficial ownership and the export nature of the business, bank must seek RBI approval for every large cash transaction. Option number D, the social and financial status of the MLA and the account being a CASA product, bank must apply simplified due diligence due to the customer public office. See, very good question it is. So let me explain in detail what the question is all about. First of all, let's talk about the red flag. So yes, the system indicate a red flag. The question quietly give multiple red flag. First red flag is that customer is an MLA. Customer being MLA is itself a red flag because MLA is an elected public representative, right? That makes him PEP. That's called politically exposed person. And this PEP is always at high risk. This PEP is always at high risk because they have political power, they have high chances of corruption and influence. The international AML rule demand extra caution, right? Since they have power, so there is a strong chance of corruption and influence. Second red flag that question had told that business is a jewelry export. Yes, they have mentioned that business is a jewelry export. So jewelry business, it is a cash intensive business. Jewelry business, it is cash intensive business. It is high value business. It is exactly easily used for layering purpose. It can be easily used for layering purpose and laundering. So RBI guideline explicitly lists jewelry as a high risk sector. Even one of these is risky, hence we both have together, right? So conclusion on the risk category is that first of all we have PEP plus cash intensive business is equal to high risk customer. That's why the why high risk part is answered. Now what is the operational consequence of this high risk? Okay, so now it is clear that it is a high risk. Now what is the operational consequence? Yes, once we know that it is a high risk, so what is the consequence of this being a high risk? Actually, once a customer is classified a high risk, bank must apply, EDD. EDD must be applied by the bank. What is EDD? Enhanced due diligence, right? Bank must apply senior management oversight. Senior management oversight, right? More frequent KYC review. So these things must be done by the bank. See, that's called, once a customer is classified as a high risk, the bank must apply EDD, senior management oversight, and more frequent KYC review. So, as per the RBI KYC norms, high risk customer KYC review is to be done every 2 years. Very important. Please note it down. Every 2 years for high risk customer review has to be done. And if it is medium risk, see, high risk 2 years. If it is medium, then it is 8 years. And if it is low, then 10 years. So option number B, option number B matches perfectly. Right? Why? What about option number A? Option number A says that under 6-month account plus jewelry business KYC every 5 years. No, that's wrong. Right? Because 5 years is not prescribed for any risk category. It is 2, 8 and 10, not a 5. What about option C? It says that complexity of the beneficial ownership and the export nature of the business. See, RBI approval is required for even large cash transaction. Wrong. It is wrong because bank needs senior management approval. In this particular case, bank need approval of the senior management, not the RBI. RBI does not approve individual customer transaction. Never. C is wrong. What about D? So D says that simplified due diligence. See, actually it is the opposite. PEP require enhanced due diligence, not a simplified due diligence. And simplified DD is for government department account, or low risk salaried employee or pensioner, right? So what is the correct answer to this question? Correct answer is option number B, right? So remember, the key way to remember is this particular answer is PEP, politically exposed person, plus jewelry is equal to high risk. So we have PEP plus jewelry means high risk, and it has to be reviewed every 2 years. Fine. So political power plus cash business, tighter KYC. So what we learned from this question is that MLA, politically exposed person, PEP are always treated like a high risk. Jewelry business is a cash intensive high risk sector, and high risk customer need enhanced due diligence, senior management approval, KYC review every 2 years. Please remember this point, very very important from examination point of view. Now let's switch our focus to the next question. Very good question it is, and this type of question are frequently being tested in the examination. So if you want to practice such question on we are on a consolidated basis, you can check out our course in the description section, or you can WhatsApp me on this particular number. So the question is on your screen, as you can see that a customer conduct the following cash transaction in their saving account during the month of October. October 5, cash deposit of 4,50,000. October 12, cash withdrawal of 3 lakh. October 20, cash deposit of 3,50,000. October 25, cash deposit of 2 lakh. Now the question is based on the provided criteria for CTR reporting. How should the bank be proceed? Option number A, no CTR is required because no single transaction exceeded the 10 lakh threshold. B says that a CTR must be filed because the total integrally connected deposit within the month exceed 10 lakh. Aggregate to exact 10 lakh. C says that CTR must be filed because the monthly aggregate of all the cash transaction, deposit and withdrawal exceed 10 lakh. And D says that only the transaction on 25th October needs to be reported as it puts the monthly total above the limit. Very good question. So every confusion regarding CTR will be cleared once you go through this question. See, let me explain. First of all, what is the rule for cash transaction report? So the rule says that if the cash transaction, if the total cash transaction in an account exceed 10 lakh per month, so a CTR must be filed. That's the rule. So important point is that month word is very important. It is monthly. This is a very important word. It is monthly, right? And it includes the deposit also, and it includes withdrawal also. So both are included. Deposit and withdrawal are included. Even if no single transaction crosses 10 lakh, right? Now you check out in this particular case what the transaction they have given. See, October 5, cash deposit of 4,50,000, cash withdrawal of 3 lakh. So you add everything. So 4.5 plus 3 plus 3.5 plus 2. How much you get? You get 13 lakh. Check out. Like 5 plus 3, 8, 8 plus 5, 13. Yes, correct. So total cash transaction is in October is 13 lakh, as you can see. Since total cash transaction is 13 lakh, and what is the CTR threshold? CTR threshold is how much? 10 lakh. This is the CTR threshold, and actual cash movement is 13 lakh. So 13 is more than 10. So clearly threshold has been crossed. So CTR must be filed. CTR has to be filed. If you look at some options that we have, option number A says that no CTR is required because no single transaction exceeded the. Actually, it is wrong, because CTR is not for single transaction. Actually, in the case of CTR, what matter more is the monthly aggregation. What about option B? It says that only deposit aggregated to 10 lakh. This is an exam trap. CTR look at the total cash flow. CTR look at the total cash flow, right? Deposit plus withdrawal, not deposit alone. It look at the total cash flow, deposit plus withdrawal, not deposit alone. So B is wrong. What about D? D says that report the only last transaction. No, it is wrong. CTR report the entire series of transactions, not just the transaction that crosses the limit. What about C? Option C says that that CTR must be filed because the monthly aggregate of all the cash transactions exceed 10 lakh. Yes, this is correct. If cash move above 10 lakh in a month, CTR moves to FIU. So what we learned from this discussion is that that CTR threshold is 10 lakh rupees per month. It includes cash deposit, cash withdrawal, everything, and aggregation apply even if transactions are on different date. CTR report the entire series, not one transaction. And to whom CTR is filed? CTR is filed with FIU IND. Just remember it. Very, very important. So I hope till now everything is crystal clear. Now have a look at the next question. So they have given a partnership firm whose name is Apex Trader. See, the question is, the partnership firm name is Apex Trader. They apply to open a bank account, right? The firm is managed by 3 active partners are there, and they have appointed a general manager who hold a power of attorney to operate the account. So based on the provided guideline, which of the following is mandatory requirement for the bank to complete the account opening process? So what is the entity name? Entity name is Apex Trader. Owner, there are 3 active partners are there. Operators are the general manager with power of attorney, right? So question is, option they have given, the bank must collect only the registration certificate and partnership deed, as the general manager is not a partner. B says that bank must obtain registration certificate, partnership deed, and an OVD specifically for the general manager holding the POE. C says that bank is required to identify the beneficial owner only if the partnership deed does not clearly state the profit sharing ratio. And D says that bank only needs the OVD of the 3 partner. The registration certificate is optional if the firm has been active for more than 5 years. So very good question it is. Let's understand the structure of the firm. Let me just explain how the structure of the firm look like. So entity is they have given is the partnership firm, right? What is the name of the partnership firm? It is Apex Trader. Owner, there are 3 active partner, right? Operator is the general manager with POA, with power of attorney. So this means partner on the firm. So basically it clearly means that partner, they own the firm, plus general manager operate the bank account. Partner on the firm and general manager operate the bank account. So both ownership and operation matter in the KYC. Now what document are mandatory for partnership firm? See, so first of all, the first thing we have is the legal existence of the firm, and for that what we need, bank must take the registration certificate, bank must take the partnership deed. These two justify the legal existence of the firm. These are the basic compulsory document, no shortcut, no exemptions. Now who is opening the account? So bank must obtain OVD of any natural person. So you have to obtain OVD of any natural person, right, on the behalf of the entity. On the behalf of the entity, you have to obtain OVD of any natural person. Here the general manager holds the POA, so he is authorized to operate the account. Yes, this general manager, he holds the power of attorney, right? So basically he is authorized to operate the account, right? So his OVD is mandatory, even though he's not a partner, even though he's not an owner, but he operates the account, he holds POA, power of attorney, so he's authorized to operate the account. So he is not partner, he is not an owner, but OVD is mandatory. That's called beneficial ownership. What about the beneficial ownership? See, partner are the beneficial owner, right? So BO identification is always required. You have to identify BO, not dependent on the profit sharing clarity. So the bank must collect RC, registration certificate, PD, partnership deed, and OVD of the POA holder, right? So this is a very important point. Now let's look at the option they have given. Option A says that only RC and partnership deed, and the general manager is not a partner. This is wrong. It ignores the POA holder. Actually, anyone operating the account must be KYC verified. What about option C? The bank is required to identify the beneficial owner only. See, this is wrong. Actually, BO identification is mandatory in all the cases. No conditional on wording of the deed, right? So it does not depend on the profit sharing ratio. What about D? D says that registration certificate optional after 5 years. Totally incorrect. No such exemption is there. Registration certificate is a primary document which is required. So correct answer is option number B. So bank must obtain RC, PD, and officially valid document specifically for the general manager holding the POA. Yes, B is the correct one. So remember this rule like EOO rule. You can just remember it like EOO rule. So entity like registration and deed, operator like OVD of the POA holder and owner. Identify the beneficial owner. Who own, who operate, who exist, right? All these things must be approved. Registration certificate, partnership deed, right? Partnership deed, registration certificate, OVD required for all the partner and all any person holding the POA, right? OVD is required for whom? OVD is required for all the partner, and also OVD is required for the person who is operating the account. For them also, OVD is required. So beneficial owner must always be identified. There is no age based or no activity based exemption in KYC. Very important concept. Now have a look at the next question. The next question is, a high net worth client attempt to transfer 8 lakh to a cell company located in a high risk jurisdiction. When the bank manager asks for the economically rational for the transfer, the client become evasive and withdraw the request. Based on the provided PMLA framework, what is the bank immediate reporting obligation? So option they have given that no report is required because the transaction was never completed and the amount 8 lakh is below the CTR threshold of 10 lakh. Option B, the bank must file a CTR since the intent was to move a large sum of money. C says that bank must file a STR within 7 working days. And the definition of STR include attempted transaction also. And option number D says that banks should tip off the client that their behavior is being monitored to discourage future suspicious attempt. Very good question. See, actually, basically, let's understand this scenario like a real bank handling a risky customer. Actually, customer is high net worth, HNW customer, HNW customer, right? Not low risk. And account amount is 8 lakh. So destination is the cell company. Location is the high risk jurisdiction. So when asked for economically rational, become evasive and withdraw the request. So because it clearly shows the classic AML red flag, so there is no clear business purpose. Cell company involvement is there, high risk country, evasive customer behavior. So AML say that suspicious. Very important thing I'm writing. Please note it down. Suspicious based on being country that the money is kept as a security with the bank. The bank give a loan against that security. The loan money is sent back to the launderer home country, right? So this is how this money move. So why it is beneficial to the launderer, right? The loan is a liability. It is beneficial to a launderer because this loan is a liability, right? This is not an income, and liabilities are legal. Liabilities are legal and acceptable, and loan often come with a tax benefit. Yes, there are some tax benefit also. So authority sees as a bank money, not the crime money. So the dirty money become clean looking money. If you look at the option that they have given, A, it facilitates the physical export of luxury asset like boats and aeroplane. Actually, physical export of luxury asset, this is international trade laundering. No loan or collateral involved, so no, not relevant. What about B? Difference between the real value and the transaction value. This refers to the invoice manipulation. This refers to invoice manipulation. It is used in trade-based money laundering. It is used in trade-based money laundering, right? So option number B is also wrong. What about C? C says that it disguises criminal proceed as legitimate liability while potentially offering tax benefit. Option C says that disguises criminal proceed as a legitimate liability. This makes exactly what is happening here. Criminal money shown as a bank loan. Loan is a legal liability. You basically what is happening here, you know, criminal money, right? They have shown like a bank loan, right? And loan is a legal, you know, loan is a legal liability, right? And interest is a possible tax advantage. So this money is called back-to-back loan. This method is called back-to-back loan, right? So the question may be asked, what is a back-to-back loan? So yes, this method is called back-to-back loan. Option number C says the same. It disguises the criminal procedure as a legitimate liability. Yes. What about D? D says that it allows the launderer to discard worthless good after paying a large sum for them. So paying for worthless good, that is again a trade finance trick. It involves goods, so no loan or collateral. So incorrect. So collateral, loan, clean. Dirty money kept as collateral, and then bank give loan, money return looking clean. So loan, liability, legal. Just remember it. This is called back-to-back loan laundering. This is the keyword you keep in mind. Loan, liability, and legal. Right. It is shown as a bank loan. Money make money look legal, tax friendly. Woman. So what the question is? A Pardanasi woman, which is a woman living in complete seclusion. She comes to a bank. Now, why she come to a bank? To open a high value fixed deposit and to give power of attorney in favor of her nephew. Now, because she live in seclusion, law give her extra protection. So basically, option they have given that which of the following action best aligning with the duty of care and the KYC guideline required to ensure that transaction is legally immune to future challenge of undue influence. Means what kind of, you know, precaution or care bank have to take care while dealing with such customer. Option number A, that accept the thumbprint on the account opening form as long as it is attested by the nephew who accompanied her. Option number B, request her to lift her veil in a general lobby to match her face with her Aadhaar or identity document to satisfy immediately. Option C, conduct the identification in a private area through a female bank official and ensure that the document implications are explained. Option number D, refuse the transaction entirely as Pardanasi women are legally classified as a person under disability. Very good question it is. So basically, because she live in seclusion, law give her extra protection. So the bank must ensure that. So we are talking to the context of, you know, Pardanasi woman. Let me write it down. Right. So bank must ensure that she is acting freely. First of all. Second thing, bank must ensure that she understand. That means woman understand what she is signed. Third case is there is no pressure or undue influence. There should be no pressure or there should be no undue influence. Now the question asks, what should the bank do to follow the duty of care and KYC so that transaction is safe and from future legal challenge. So the first point is a special legal protection, right? So you know, under Indian law, a Pardanasi woman can enter into contracts. Yes, and under the Indian legal law, she can enter into contract first of all. But the burden of the proof is on the bank. Please remember, the burden of proof is on bank to show that she signed with the free mind. First of all. Second case, she understand the document. This is on the bank. She understand the document and there was no undue influence. This bank has to prove there was no undue influence. Fine. So now let's see the option. And second thing is, you know, privacy and dignity. Let's talk about the privacy and dignity also, this aspect also. So basically, asking her to lift her veil in general lobby, it violate her privacy. It violate her privacy and cultural practice. So proper SOP say verification should be done privately and sensitively, not you know, actively. Now what about female official? Yes. So let's look at the option that they have provided. If we see option number A, so special legal protection. So yes, I told you that special legal protection is given to her. So conducting identification in a private area. Yes, correct. So the female bank official, see, when a female bank official, you know, C is a safer compliance. C reduces discomfort and risk of allegation. Court expect bank to take extra care, not minimum care. So option C shows the maximum care possible. That C is identification is done in private area through the female bank official. Ensure document application are explained to her in language, ideally in the presence of independent witness. Now, what is the independent witness? This is a kind of legal shield, right? So nephew is a beneficiary, so he cannot be trusted as a witness. So please understand what is the condition for independent witness. The key word is independent witness, which means so an independent witness prove that no pressure. First point. Second is no coercion, and the third is voluntary execution. Voluntary execution. Fine. So if you look at the option, only option C satisfy all these things, right? What option is say? Option is say thumbprint. Option is say thumbprint attested by nephew. See, actually it is wrong, because nephew is an interested party. First of all, nephew is an interested party, right? So high risk of undue influence allegation. So legally it is weak. What about B? Lived valley in the lobby? No. Correct. Incorrect. So this violate her privacy against the cultural sensitivity, right? And not required under KYC norms. What about option D? Refuse transaction? No. Actually, completely wrong concept. Partnership women are not legally disabled. They have full right to contract. Law only give them extra protection, not restriction. So what's the correct answer? Option number C is the correct answer. Please remember that Pardarshini woman plus bank transaction, right? High duty of care. Please remember it. This is the keyword to remember. High duty of care. So bank must prove the free consent, full understanding, no undue influence. So you can remember it like a rule. Let me give you a trick to remember it. You can remember it PFI rule. What is the meaning of PFI? P means private verification. F means female bank official. And I means basically independent witness. So these are the utmost requirement to the context of Pardarshini woman, independent witness. So what we learned from there, if all the three are present, safe and legally strong transaction. PFI, private verification, female bank official, independent witness. So Pardarshini woman can sign contract, bank bear the burden of proof, privacy, explanation, witness, protection, ensured protection, and sensitivity is a part of the KYC and duty care. I hope till now everything is crystal clear, and exactly same question was asked in the examination. So since you know the concept, you can easily answer any question which will be asked in the upcoming examination. So if you are looking for one-stop solution for your AML KYC preparation, you can check out our course which is available on the app JIB and CIB Made Simple. In this I have added AML and KYC content, mock test and quizzes. So in the case of AML and KYC content, you get unit wise theory, unit wise MCQ, previous year question, capsule revision content. In the case of unit wise theory folder, it has been divided into two parts, part A and part B, as per the reference book prescribed by IIBF. Similarly, in the case of part B, in the case of unit wise MCQs, you get MCQs for each and every unit. Like you can see, they have been arranged unit wise. All these PDFs are downloadable. You can download them instantly. In addition to that, we provide you previous year question, which consists of memory based question starting from February 2025. In addition to that, we also provide you mock test for practice, right? So all these things you can get a very nominal price, right? So check out the link in the description section, or you can WhatsApp me on the number shown on the screen to get more details. They have mentioned Eden Heritage Trust is opening a corporate investment. So basically the trust name is Eden Heritage Trust, and they want to open a corporate investment account. See the keyword I am highlighting here. Let me highlight it. Eden Heritage Trust corporate investment account, right? The trust deed mentioned 4 people. Who are the 4 people? Mr. A, who is the author or who is the settler. We can also call them settler, right? Then Mr. B, who is the trustee, right? Sorry, Mrs. B is trustee. Master C, who is the beneficiary, 12% income share, as you can see. And Mr. D, who is a protector with a veto power. Fine. So these are the trust these are the 4 people who are mentioned in the trust deed. Now the question is, as basically which individual satisfy the criteria for a beneficial owner, right? So actually the question pertains to beneficial owner. You should know the criteria for beneficial owner, and you have to select which one satisfy the beneficial owner. So they have mentioned about Mr. A, who settled the trust with one-time corporate corpus of 10 lakh. Mr. B, Mrs. B, a professional lawyer managing the trust asset. Master C, a minor with a fixed 12% entitlement. Mr. D, a non-beneficiary who hold the veto power to dismiss trustee. Right. So now let's first of all clarify the concept. So option they have given only Master A, only Mr. A and Mrs. B, A, B and D, all the 4 individual. Very good question. Let's first of all clarify the concept. So, you know, when it comes to trust, please understand. When it comes to trust, beneficial ownership is not about money. Beneficial ownership is not about money. Rather, it is also about, you know, control and, you know, authority. Control and authority. So there are 3 key rules. So how many rules are there? There are 3 rules to identify whether beneficial owner. So the first rule is called the role rule. So what does it say? What does this rule say? Let's have a look. So this rule says that, you know, if you look at the Mr. A, he created the trust. Second, he put the initial money. So automatically he becomes the BO, beneficiary owner. Now, what about the trustee? Let's have a look at the trustee. Who is the trustee? Mrs. B. Mrs. B is the trustee, as you can see. Right. So if you look at in this particular case, they have mentioned, yes, Mrs. B is the trustee. So she manages and control the true asset. So what are her role? Let's have a look. So she manage and control the asset. So please remember, control is more important than profit. Fine. So automatically she become BO. So therefore Mr. A and Mrs. B must be KYC compliant. Now there is another rule. Please remember, there is another rule for BO. That's called, you know, let me write it down using different color. Okay. So that's called, you know, 15% rule for beneficiary. So see, suppose there is a beneficiary. Right. So beneficiary become BO, that is beneficial owner, only if he or she has more than 15% interest. Now look at the case of Master C. If you look at the Master C, he has in income entitlement of only 12%. 12% income entitlement. Fine. So below that 15% threshold. So hence Master C is not a beneficial owner. What about D? So and one more rule is that's called, you know, control rule. I told you, na, control rule is more important than money. So what does control rule say? It says that even if someone get no money, suppose someone get no money, or but he has a power, but someone get no money, but he has the power to control decision. He has the power to control decision. So he is a BO, right? Now let's look at the Mr. D, who is a protector. So he can dismiss trustee. Right, he can change investment strategy. He has the veto power. This means he has the ultimate effective control. Ultimate effective control lies with protector. So therefore Mr. D must be treated like a beneficial owner. Right, because he has the veto power, he has the control. So this is a BO. So if you look at the option number A, only Master C, this is incorrect. Why? Because income alone is not enough, and also if you look at the Master C, income is just 12%, which is below the threshold. If you look at the option B, A and B, actually they ignore the control test. Control test is also very important. Protector with veto power cannot be ignored. So it's wrong. C says that A, B and D. Yes, correct. D is all 4 wrong. Beneficiary below 15% are included. So remember, what we learned from this discussion is that if you talk about the trust to the context of BO to the context of trust, please remember, role is also important, plus percentage interest is also important, plus control is also important. So this you can remember using a simple rule. That's called, STC rule. So S means, settler. He is a beneficiary, or we can also call it author. He is a beneficiary. T means trustee. Trustee is a beneficial owner. C means controller. Controller means protector or veto holder. He is also beneficial owner. So STC, please remember, beneficiary only if more than 15%. So settler and trustee are always BO. Beneficiary is BO if they hold more than 15% share, and control without money is still BO. Minor status does not matter here. So trust BO is all about power, not just profit. I hope everything is crystal clear. Option C is the correct answer. Now have a look at the next question. So author, settler mandatory, trustee mandatory, beneficiary only if interest is more than 15%. Right, I hope it is clear. Now question number 3 of today's session. This is regarding the PMLA. Under the PMLA, that is the Prevention of Money Laundering Act. So the money laundered is linked to a schedule offense in a part A, right, of the schedule. Especially a narcotic related offense that they have given. So the question asks, what is the maximum punishment, that is a rigorous imprisonment, that the court can award under the section 4 of the PMLA? Option A, up to 3 years and mandatory fine. Option B, not less than 3 years but extending up to 7 years along with a liability for a fine. Option C, not less than 3 years but extending up to 10 years if the money laundering is related to a specific drug related offense. Option D, exactly 7 years with no provision for a fine if the amount exceeds 1 crore. So very good question it is. Let me explain step by step. So first of all, to answer this question, we must understand the section 4, right? We must understand the section 4 of the PMLA. So what does this section say? See, basically this section talks about, punishment for money laundering, right? It talks about the punishment for money laundering, right? Not the original crime. So what are the general rules under section number 4? It says that, for most scheduled offense, it says for most scheduled offense, punishment is minimum 3 years. 3 year minimum punishment, right? And maximum punishment is 7 years. 7 year maximum. And fine can also be imposed, right? This is the standard punishment range. 3 year minimum, 7 year maximum with fine. A standard range, right? Now, a special exemptions for drug related crime. Please note, for drug related crime, there are special exemptions. So if the money laundering is connected to offense under NDPS Act. What is NDPS Act? Narcotic Drugs and Psychotropic Substance Act 1985. So what I mean to say, that if this money laundering is connected to the offense under NDPS Act, the law become quite strict. In that case, law become strict. In such case, what happen? Maximum punishment remain 3 years. Sorry, minimum punishment, not maximum. Minimum is 3 years, which is the same like we have seen earlier, right? 3 years was there also, but maximum punishment, it increases. Earlier it was 7 years, now it become 10 years. So this special tax provision is clearly mentioned under the section number 4. It clearly mentioned in the section number 4 of the PMLA, right? So let's apply this to the question. So friends, basically the offense is narcotic related. Clearly they have mentioned narcotic related offense, and it is listed in the part A of the schedule. Also they have mentioned it, that this is listed in the part A of the schedule. So therefore a special NDPS provision will apply. Hence the court can award up to 10 years of rigorous imprisonment. If you look at the option number A, it says about 3 years and a mandatory fine. So this is incorrect. 3 years is a minimum, not a maximum. Question is asking you maximum term. Option number B, maximum 7 years. See, this is also wrong. It applies only to non-NDPS offense, right? So remember, maximum 7 year apply to non-NDPS offense. What about option C? Not less than 3 years but extending up to 10 years. Yes, correct. C is correct. Is that right? Please let me write it down. Section number 4 of the PMLA, right? This is about the punishment. Fine, for ML. Punishment for ML. So remember, if it is normal case, then punishment can range from 3 to 7 years. And if it is NDPS linked case, it can be 3 to 10 years, right? So one memory trick I can tell you to remember it like this. Just remember, drugs, double digit. Fine. So if laundering involved drug, maximum punishment can go to 10 years. I hope it is clear. Now have a look at the question number 4 of today's session. Question number 4 is on your screen. As you can see, they have mentioned that when a bank or business correspondent perform a Aadhaar eKYC, right, transaction with the customer explicit consent, which of the following combination of data is electronically transferred by UIDAI to the bank system? Option is name, mobile number, father name, GPS location, name, age, date of birth, gender and photograph, name, photograph, address, registered bank account number, name, date of birth, gender, photograph and address. See, to solve this question, you must clearly understand the difference between the Aadhaar authentication and Aadhaar eKYC, right? So basically, once you understand the difference, you can easily answer this question. So let me explain. What is the difference between these two terms? On one side we have, Aadhaar authentication, right? Another side we have, Aadhaar eKYC. So let's start with eKYC. What's the meaning of eKYC? See, it is a paperless KYC process. UIDAI send verified demographic data electronically. So under eKYC, UIDAI, they send demographic data. They send demographic data electronically, and this happen only with the customer consent. Yes, customer consent is needed for this Aadhaar eKYC. So bank rely on this data for two things. Bank rely on this data for proof of identity, and also bank rely on this data for proof of address. Fine. Now what does UIDAI actually say? So in a full Aadhaar eKYC, please remember, in a full Aadhaar eKYC, right, UIDAI share 5 demographic detail. The first one is name, second thing is date of birth or age, third is gender, fourth is photo, and lastly we have the address. These are the 5 things that are shared by the Aadhaar UIDAI, right? So these 5 together fully satisfy the RBI KYC norms. Fine. Now let's look at the option. Option number A is given GPS location. No, that's wrong. UIDAI does not track or share live location. Aadhaar is an identity database, not a surveillance system. What about B? So it's talk about the missing address. Yes. So incomplete. Address is mandatory. For proof of address, address should be given. And address has not been written here. Bank cannot open account without POA. What about C? Bank account number. C. Bank account number completely incorrect. UIDAI never store or share bank detail. The correct answer is D. Name, date of birth, gender, photograph and address. Right. So NDGPA. Then if all these 5s are present, that's called full eKYC. So remember, I hope till Aadhaar authentication, when I say it is just yes or no, right? And Aadhaar eKYC is the demographic data is shared. In case of Aadhaar authentication, right? So like a bank or business correspondent, they perform this Aadhaar eKYC after taking the customer consent, right? They take the customer consent, they perform this Aadhaar eKYC. So they UIDAI electronically send these kind of data to the bank system. Once they perform Aadhaar eKYC, UIDAI send the name, date of birth, gender, photograph and address to the bank system, right? So bank rely on this data for two things, for POI and for POA, right? For these two things, bank rely on this data. So I hope till now everything is clear. So what we learn, Aadhaar authentication is just yes or no, while Aadhaar eKYC is the complete demographic detail is shared, GPS location is never shared, bank account number are never shared, address is essential for bank eKYC. Now have a look at the next question. Yes, this is a very good question regarding the layering. So what this question is all about? A criminal syndicate has earned a lot of illegal money, right? A criminal syndicate has earned a lot of amount of black money. To avoid reporting rule like CTR, So the bank break the cash into a small amount and use many people who are called Smurf deposit money into hundred of bank account, right? So the question is, in the 3-stage model of money laundering, which stage does it actively primarily represent? Layering, placement, integration, structuring. So to answer this question, you must remember that money laundering always happen in a fixed order. So there is a fixed order, right, in which money laundering happen. So what is the fixed order? See, there are 3 stages. How many stages? 3 stages are there. Fine. So the first stage is called the placement. Let me explain once more. We have explained it several times in the previous lecture. So placement, what happened here, this is the first and most risky stage for criminal. So if I ask you which one is the most risky, so placement is the most risky for the criminal. What happened here, physical illegal cash is introduced into the banking system. So illegal cash is introduced where? In the banking system, right? And what are the common method? So basically, criminal try to avoid detection. Common method is use of Smurf, right? Cash deposit in a small amount. In a small amount, you deposit the cash, or structuring the deposit. So in this question, cash from street came, deposited into many bank account, done to avoid CTR. So this is the placement, right? Now, what about smurfing? So smurfing, see, one more thing you must note it down. That smurfing means, breaking big cash into a small deposit. So you have big cash and you are breaking into a small deposit. That's called smurfing. Purpose is to place cash into bank quietly. Even though it looks very complex, but it still belongs to the placement. So what is the correct answer? The correct stage is the placement stage, right? What happened? What about layering? So layering happened after the money is already inside the bank. So now the money has been placed, right? Money has been placed inside bank. So layering means, multiple transfer occur. Okay. So also it includes foreign remittance. Fine. And sometimes investment is done to confuse the trial. Not applicable here. What about integration? So when I say integration, it just means, final stage, money look fully clean. Money look fully clean and it appeared like a business income, property sale, right? Or you can also call it, luxury purchase. Fine. So that's called integration, which means, money looks like fully clean. It appears like a business income, property sale. So not the case here. What about structuring? Structuring is the main trap. So structuring is a technique used during placement stage. Technique is not a stage. Option D is incorrect. So remember, if you look at the 3 stages of money laundering, the first is the placement. After placement, layering is done. And after layering, integration happens. Right. So remember, this cash deposit is always the placement. Right. So CLI, you can remember it using the trick. What is the trick? CLI. Cash crime, land into bank, and I for initial stage. If cash is entering bank for the first time, it's called placement. Right. Please remember it, very, very important. So remember that placement means introducing illegal cash into the bank. Layering means hiding trial after placement. Integration means enjoying the clean money. Now friends, the question is regarding the Volkswagen group. So basically the question is, which of the following is not a member of the Volkswagen group? HSBC, Goldman Sachs, SBI, JP Morgan Chase. So the Volkswagen group is a non-governmental organization. Please have a look. So remember, this is a non-government association of the global bank that developed the AML KYC standard that is followed worldwide. So you should know what the Volkswagen group really is. So it is a private association and members are large international bank. Purpose is to create the best practice standard. What is the purpose? Purpose is to create the best practice standard for what? AML, KYC, correspondent banking, sanction, etc. It is not a government body. Membership is limited and exclusive. So only selected global private giant can be member. Right. Total member is 12 only. Right. Membership is by invitation, not by size or country importance. So yes, HSBC is a member of this. This is the global private bank. Goldman Sachs is a global investment bank. JP Morgan and Chase, yes, but SBI is not. It is globally significant, but not a Wolfsburg member. So banks centered are Bank of America, Barclays, Citigroup, Credit Suisse, Deutsche Bank, Goldman Sachs, HSBC, JP Morgan. So there is the name, right? These are the 12 members. You can check out. So these are the mostly Western or Japanese private bank. So the common exam trap is that, big bank means Wolfsburg member. No. SBI follow the Wolfsburg principle, but following a standard is not being a member. So remember, Wolfsburg group, private body are member. And what about FATF, Financial Action Task Force? So FATF, this is the inter-government body. So countries are the member. The difference is frequently tested in the examination. Mostly US, UK, European or Japanese bank are there. Now friends, have a look at the next question. The question is, a medium risk retail customer opened an account and completed their KYC on 1st January 2018. Okay, fine. According to the standard RBI periodic updation cycle, by which year must the bank perform the next mandatory full KYC refresh for this customer? So friends, the medium retail customer opened the account, completed full KYC on 1st January 2018. Right. So to solve this question, we only need two things. First of all, what is the risk category of the customer? Second thing is RBI KYC updation cycle. Right. So we need to know these two things. So you know it very well that RBI classify the customer into three risk category. So RBI classify the customer into three risk category. Fine. So what are the risk category? First is called high risk. High risk means KYC updation is done every 2 years. Then we have the medium risk. Medium risk means every 8 years. And then we have the low risk. Low risk KYC updation is done every 10 years. Now in this particular case, as you can see, they have clearly mentioned that this is a medium risk. Right. So medium risk, 8-year cycle. Now last KYC done on 2018. So medium risk cycle is 8 years. So 2018 plus 8 years, which is 2026. So therefore the next mandatory full KYC refresh is due in 2026. So if you look at the 2020, so this apply only to, this high risk customer. If it is high risk, then every 2 years
up to 50,000 and to account holder who are KYC compliant. Option C say cooperative bank are allowed to issue at par check only for their own use. Issuing to customer is strictly prohibited. Option D say at par check need not be cross account payee if the amount is below 50,000. The peculiarity of this question is that every concept related to at par check will be clear if you go through this particular all the four options. And that is why what I want to do, if any question is asked based on this at par, you can easily answer it. So friends, please pause the video right now and think about the answer. Which of the option which do you think is correct? Let's see option by option. First of all, option number A. It says that cooperative bank can issue at par check to any customer for any value. It sounds flexible, right? But this is wrong. Why wrong? Because RBI has put a clear limit that bank cannot give at par check to anyone for any value. Right? Bank cannot give at par check to anyone for any value. Remember it. Right? For example, suppose someone walk in with 2 lakh cash and want at par check. Suppose one person is there who walk in with 2 lakh rupees cash and he want at par check. So what will happen? In that case, bank cannot just give it after noting it down. A strict control apply. Option number B says that at par check may be issued only to walk-in customer. Yes, this is the correct statement. Right. So there are something something to be kept into in mind while issuing the at par check. The first point is that that walk-in customer, right? So only walk-in customer can get that par check, and up to how much? 50,000 rupees. That too up to 50,000 rupees only. Okay, against the cash. And what about account holder? If there is an account holder, they are also allowed to get at par check, but only if their KYC is compliant. And if the amount is 50,000 or more, in that case, check must be issued by debiting the account directly. You have to debit the customer account, not against the cash, right? So let me give you one example. Take the case of Mr. Sharma. So now Mr. Sharma, Mr. Sharma has fully KYC verified account. His account is fully KYC verified, right? He want a check of 1 lakh. He want a check of 1 lakh. Okay. So the bank can issue it, but only by debiting his account, not by taking the cash, right? That is called at par check. What about option C? Cooperative bank are allowed to issue at par check only for their own use. This is also wrong. Why it is wrong? Because yes, bank can use this check for their own need, but they are also allowed to issue them to customer with the restriction we have just discussed, right, in the previous option. Option D say that at par check need not be crossed account payee if the amount is below 50,000. Think about it. Do you think this is correct? This is wrong. So RBI say that all at par check. What RBI say? That all at par check, no matter the amount, must be crossed account payee. It must be crossed account payee, no matter what the amount, right? That is the point. For example, even if it is just rupees 10,000, the check must carry the account pay crossing to avoid misuse. Why there should be account pay crossing? That this way we avoid misuse, right? So friends, the correct answer is option number B, which clearly explains the RBI rule for both walk-in customer as well as the account holder. So what we learned from this discussion is that that cooperative bank can issue at par check only under strict law. First of all, walk-in customer, if there is a walk-in customer, right? So to walk-in customer, again cash it can provide only for amount less than 50,000 rupees per individual. And if it is account holder, he must be KYC compliant. If he is KYC compliant, then any transaction of 50,000 or more, right, against that amount, par check can be issued by debiting to the customer on account. Remember it. And one more point is that all check must be crossed regardless of the amount. All check must be crossed account payee, irrespective of the amount. The purpose is to prevent the misuse, money laundering, and to keep transaction traceable. So that was a simple breakdown of at par check facility. Remember these limit, remember these condition, very important from your examination point of view as well as practical banking knowledge. So friends, I hope this concept is clear. Now friends, let's see the question number 2. The question number 2 we have is, in the context of banking regulation, which of the following is essential for opening pooled account for entities like mutual fund and pension fund? So it is a very good question. Options are, no due diligence is required if the entity is government owned. Option B say, the bank must verify that the fund has the required registration or approval and conduct due diligence with supporting documentary evidence. Option C say, the pooled account are permitted only for individual customer with high net worth. Option D say, bank can open pooled account for any entity without verifying the nature of the fund. So this question revolves around the pooled entity, right? So what do you think about the option? Right. So what do you think about the option? So let's talk in the context of banking regulation, right? So we are talking about the pooled account. This is our center of gravity. Now first of all, if you see the option number A, so option number A is wrong. Why it is wrong? Because even if it is government backed, even if the entity is government backed, right, government backed fund, bank must do the due diligence. Due diligence is very much necessary. Suppose a state pension fund apply for pooled account, the bank still has to verify the document and check registration. There are no shortcuts. So option number A is wrong. What about B? Yes, B is correct. Right, because before opening such a pooled account, bank must check if the fund has proper approval from regulator like RBI and SEBI. First of all, bank has to check the regulator approval. This is the first thing, right? Second thing, they should check the proper document as evidence, supporting documentary evidence, and they should carry out due diligence. Yes, due diligence, they should conduct due diligence. So first thing is the registration and approval from the regulators. Second thing is due diligence, and third thing is supporting documentary evidence. For example, suppose a mutual fund house come to open a pooled account. The bank cannot just trust their word. It must check SEBI registration. It must check SEBI registration certificate and keep a copy in the record. Right? Option number B is the correct one. What about C? Pooled account are permitted only for individual customer. This is incorrect. Why? Because pooled account are for regulated entities. Remember, the pooled account are not for individual customer. Rather, pooled account are for regulated entities. Okay? So, like mutual fund or pension fund, they are not for individual. For example, a billionaire cannot say that I want to pool my account like a mutual fund. That is not allowed. What about option D? Bank can open pooled account for any entity without verifying the nature of the fund. This is clearly wrong. Because verification of the source and the nature of the fund is at the heart of banking regulation. Two things is at the heart. First of all, source verification. And the second thing is, fund nature. Right? Source verification and fund nature is at the heart of the banking regulation. Without this, money laundering or illegal pooling could easily happen. So the correct answer to this question is option number B. Right? Bank must always check registration, approval, document before opening pooled account. So what we learned from this question, let me summarize. I told you that pooled account are allowed for regulated entities. Right? So they are allowed for what? They are allowed for regulated entities. Like a mutual fund or pension fund. And bank must do the full due diligence. So due diligence is the must before opening such account. And proper registration and approval must be verified. Right? Proper registration, approval must be verified to prevent misuse, money laundering or unregulated entity. So I hope this concept is clear. What is the meaning of pooled account? What is the significance of it? Right? I hope it is clear. Now friends, let's see the next question. So remember, pooled account are powerful tool but come with a strict compliance check. Friends, if you are looking for study material for your AML KYC examination, then you can check out our course in the description section. I have provided the link, or you can install our app. Name is JIB and CIB Made Simple. So in this particular course, you will get such kind of memory based question recollection with their proper explanation. You see, I have explained each and every option, right? Not only you get answer, you get proper explanation of each and every question. You will get to know that yes, this question appear in the examination and why, right? And also beside that, in addition to that, you will get concise notes. You will get 2000 plus MCQs for practice purpose, and also you will get short capsule content for quick revision. So all these things are available in our course, or you can WhatsApp me on this particular number to get more detail regarding the course. Now friends, let's look at this particular question. The question says that as per the regulatory provision under the Prevention of Money Laundering Act, that is called PMLA. As per the regulatory provision under PMLA, what is the range of monetary penalty? So the question revolves around the monetary penalty that can be imposed for each instance of failure to comply with obligation by a reporting entity, designated director or employee. Very good question. 1,000 to 10,000, 5,000 to 50,000, 10,000 to 1 lakh and 50,000 to 5 lakh. So let's start with the option number A. This is wrong. Why? Because this looks small, right? But it is wrong. The law is much stricter. Just imagine if a big bank fail in compliance, a penalty of 1,000 rupees would be nothing. So this option underestimated. What about 5,000 to 50,000? This is incorrect. It's still too low compared to what the law actually prescribed. Right? Remember the point that penalties under PMLA are designed to be deterrent. You know the meaning of this deterrent? Deterrent means they must be high enough to make institution take compliance seriously. Right? They must be high enough so that the institution take compliance seriously. Yes, this one is the correct one. 10,000 to 1 lakh. Right. So remember the section number 13 of PMLA. Section number 13 of PMLA says that penalties shall not be less than 10,000 and may go up to 1 lakh for each failure. For example, suppose a bank failed to report 5 suspicious transactions. The penalty can be calculated separately for each lapse. See, this is for each instance. Suppose bank failed to report 5 suspicious transactions, then 50,000 will be the penalty. 5 lakh will be the penalty. Right. And option number D, this is an overstatement, 50,000 to 5 lakh. The maximum penalty is not 5 lakh. Per instant, it is capped at 1 lakh rupees. Right. So what we learned from this question, we learned about section number 13 of the PMLA. I told you that section number 13 of the PMLA empower the director to impose a monetary penalty. Penalty range can be from 10,000 to 1 lakh rupees. It is applied to the reporting entity, designated director as well as employee. Remember, designated director, board, reporting entity or any of the employee. Right, all of them come under it. Right. So I hope it is clear. The idea is to ensure that state compliance and discourage negligence in anti-money laundering measure. So remember, even a single failure in compliance can cost heavily under PMLA. That is why proper reporting and documentation are non-negotiable in banking. Now friends, let's do one case study. Yes, I have bring before you case study also. Exactly the same case study was asked in the examination. 5 questions were there. Let's understand basics. So friends, what the question is all about? Basically, in our case, we have multiple company, right? Messrs XYZ Limited, whose director are Mr. A and Mr. B. Messrs Element Limited, whose director are Mr. C and Mr. D. They are run by different director, but they open current account declaring themselves trader in cloth, using the same contractor. Yes, they are using the same contract address and they are using the same email, right? These individuals also operate multiple other companies that have account at the branch, and they provide the same address, questionably identity proof, same identity proof, right? Means with doubtful identity proof, and they open multiple account in the same branch. You see now, they operate multiple other companies, they open multiple account in the same branch. So they are doing huge fund transfer. In addition to that, they are conducting large credit and fund transfer. Okay, they deposit just below the reporting threshold, right? So that is the point. That the deposit is below the threshold. Cash deposits are just below the reporting threshold, and credit is more than the rapidly exceed the declared annual turnover, right? So obviously, at the time of opening the account, you have to declare your turnover, and the actual credit is exceeding the declared turnover. So clearly suspicious, right? Now let's take the question. The question is asking you that which key indicator most strongly suggests potential money laundering, right? Which key indicator from the above scenario most strongly suggests potential money laundering? Options are all companies supply the same product. Option B, cash deposit are made into multiple accounts just below the 10 lakh. Option C, multiple directors are involved in different company. Option D, use of driving license as ID proof. Let's look at option by option. First of all, option number A, all company supply the same product. No, not a strong red flag. This is not a red flag, right? It is a red flag, not a strong red flag. Many company can trade in the same product like cloth, nothing illegally by itself. Yes, option number B is the correct one. This is called, smurfing. This question was also asked. What is the meaning of smurfing? Smurfing you call it, or you call it structuring. Please understand the concept. Either you call it smurfing or you call it structuring. See, what is the meaning of smurfing and structuring? Breaking a big amount. This is a big amount. You are breaking it down into smaller chunks to avoid crossing the 10 lakh CTR limit. CTR limit is how much? CTR limit is 10 lakh. You don't want to cross that. That's why you split the big chunk into smaller part. Like suppose instead of depositing 12 lakh in one go, they deposit 9.9 lakh in multiple account to escape reporting. What about option C? Multiple directors are involved in different company. Not unusual. Director can be involved in many firms legally. Use of driving license? No. Completely valid KYC proof? Not a red flag. So the key suspicious indicator here is option number B, that deposit are just below 10 lakh, right? This is the key indicator. Now let's look at the second question. What should the branch next compliance step after identifying the suspicious pattern described? Now it is clear that yes, there is a suspicious pattern. So what should be the branch next compliance step? Option A, submit an STR to FIU IND within 7 days. Call all director to the branch immediately. Close all the involved account without reporting. Wait 3 months to observe further activity. Yes, obviously option number A is the correct one. Why? Because once suspicious is confirmed, the principal officer, try to understand, whose responsibility is principal officer. Sometimes responsibility of principal officer is also asked. The principal officer, once the suspicion is confirmed, the principal officer must report to FIU IND. He must report to FIU IND within 7 days. He has to report to FIU IND within 7 days. Option number B say call all director to the branch immediately. This is not required. You don't confront customer. You report quietly. What about C? Close all the involved account without reporting. This is again wrong. Wrong and dangerous. Closing without reporting, high risk evidence. Wait 3 months to observe further activity. So law require immediate reporting. Delay is violation. If you delay, you are violating the law. You have to immediately report it. So the branch must file STR with the FIU IND within 7 days. Now the next question is, this responsibility is entrusted with the principal officer. Okay, FIU IND, Financial Intelligence Unit India. Now the last question of this case study is, which record keeping obligation apply to the bank? Maintain all prescribed transaction record including KYC for at least 5 years. Keep only cash transaction record above 50,000. Destroy all suspicious transaction record after 1 year. Only maintain record for non-profit account. Yes, you are thinking correctly. Option number A is the correct one. PMLE required bank to keep transaction record, KYC documents, suspicious activity for at least 5 years. This is a major requirement. And option number B says that keep only cash transaction. That's completely wrong. This is wrong, because all type of transaction must be maintained, not just cash. C says that destroy all suspicious transaction. This is also wrong. That would defeat the purpose of investigation. Why would you investigate then? If you are destroying all suspicious transaction record, why would you investigate? And option D says that only maintain record for non-profit account. This is again wrong, because rule apply to all account, right? Rule apply to all account, not just NGO. So the correct answer is option number A. Right. So what we learned from this discussion is that, we talked about the red flag. So what is a red flag? First of all, we talk about the red flag. So any cash deposit just below 10 lakh, this is a red flag, and this act is called, smurfing. This act is called smurfing, or you call, structuring. The action. So this is a red flag. What action should be taken? The action should be taken that you have to file the STR. Branch or, principal officer of the branch, they should file the STR. With whom? With FIUIND. Within how many days? Within 7 days of conduct of, concluding suspicion. Record keeping must be maintained for 5 years. So friends, whenever you see unusual transaction like deposit just below the limit or multiple account with fake addresses, think PMLA. Detect, report and maintain record. That's the golden triangle of compliance. There's a golden triangle of compliance. You detect it, right? After detecting, what you do? You report it. After reporting, what you do? You maintain record, right? That is a golden triangle. If you think that this video is adding value to your preparation, please hit that like button. This will motivate me to make more such content. Now, very good question from the book in front of you. The question is asking you, which of the following is not one of the 4 key elements mandated by the RBI to be included in the KYC policy of the bank? In the KYC policy of the bank, there are 4 elements, right? Which of the following is not one of them? CAP, Customer Acceptance Policy. CIP, Customer Identification Procedure. Option is C is Customer Feedback System. Option D is Monitoring of Transaction and Risk Management. Now let's understand each option one by one. Option number A says CAP. So what is the meaning of CAP? Let me explain. So CAP means, that bank must have clear rule on who they will accept as a customer. So that means, banks should have clear rule that yes, I will accept this person as a customer, right? For example, no bank can open an account for a person with fake name. Suppose there is a person, he has fake name, okay, or he did not have a proper document. So no bank can open an account of such person. So CAP help stop anonymous. So if you have proper CAP, you can stop anonymous or sale account, right? You can stop anonymous and sale it. Is it clear? Being used for illegal activities. Now option B says CIP. Yeah, right. This is about, CIP. Yes, CIP is one of the key policy because, CIP means you verify the customer identity. It's all about verifying the customer identity. Think of it like showing your Aadhaar card, right? You can think of it like you are showing your Aadhaar card, you are showing your PAN card or passport while opening a bank account. The bank uses this document to confirm that you are a real person, not a fraudster. This is also a correct element of KYC. Option C is customer feedback system. See, this sounds nice, right? Feedback is always good. But in the context of RBI KYC policy, feedback is not a mandatory element. Remember, this is not mandatory element. Okay, RBI is more concerned with the preventing fraud and money laundering, not with whether you like the bank service or not. So this option is not the part of the four element of KYC. Option D say monitoring and risk management. Bank don't just stop at just identifying you. They also keep an eye on your transaction, right? Bank always keeps an eye on your transaction. For example, if a student account suddenly receive 50 lakh, the bank will flag it as suspicious. If one student account receive 50 lakh, bank will flag it as suspicious, isn't it? So these fall under the monitoring and risk management. Bank classify customer as low, medium or high risk and apply extra check when required. This is the correct part of KYC. So what we learned here, let me just summarize. First of all, I told you about CAP. CAP means rule for accepting customer. CIP, verifying customer identity with valid document. Monitoring, watching for suspicious activity. And risk management. Risk management means, classifying customer by risk and applying a stricter check for higher risk one. But what about the feedback system? This is not the part of RBI mandatory KYC policy. So remember, the focus of KYC is fraud prevention and due diligence, not customer satisfaction survey. The next question is very good. Question is asking you, interesting question, that FIUIND was established in which year and to whom governing body does it report? Very good question. Options are 2014, report to Ministry of Finance. 2004, report to Economic Intelligence Council headed by the Finance Minister. 2010, report to RBI. 2018, report to Ministry of Home Affairs. So first of all, option number A. This is incorrect. Option number A is incorrect. Why? Because FIUIND was not set up in 2014. Right? It was created much earlier. Also, while it works under the Ministry of Finance, it does not report directly to it. Yes, option number B is the correct one. Remember, FIUIND was set up in the year November 2004. Think of it as India's central body that keep an eye on the suspicious money movement. Like if someone is laundering money or someone is doing financial terrorism. Whom it report to? It report to the EIC. You know EIC, Economic Intelligence Council. That is called EIC, which is chaired by the finance minister. So who is the chairman of EIC? Finance minister is the chairman of EIC. Just remember it. That gives authority to coordinate with other agency like ED. Yes, it can coordinate with ED. It can coordinate with CBI. It can coordinate with RBI. Right? So remember it. Option C is established in 2010. No. FIU-IND is not an RBI body. RBI may regulate bank, but FIU-IND has a wider role, covering all suspicious financial transactions in the country, whether through bank, financial institution or intermediary, not only bank. Option number D say 2018 by report to the MHA. This is again wrong. MHA deals with internal security, but FIU-IND is specifically tied to the Ministry of Finance and report to the Economic Intelligence Council. Option number B is the correct. So what we learned from this question is that, FIU-IND is a watchdog, right? They are the watchdog of suspicious financial transaction. Established in the year November 2004 under the Ministry of Finance, reports to EIC. EIC is stands for Economic Intelligence Council. They work with multiple agencies like ED, CBI, RBI to fight money laundering and financial crime. Now friends, the good question is, which of the following best describe the technique of smurfing? Just now we have discussed in the money laundering. What is the meaning of smurfing? Options are depositing large sum of money into single account, breaking up large cash deposit into a smaller amount below reporting threshold, using offshore account to invest in legitimate business only, transferring money internationally without using the bank account. Very good question. So friends, option number A says the depositing large sum of cash into single account. See, this is actually the opposite of smurfing. If someone deposits huge cash in one account, it immediately raises suspicion, right? And trigger what? It triggers CTR. CTR, this is called cash transaction report, right? So smurfing is about, avoiding attention, not attracting it. So option number A is saying that attracting attention. No, that is wrong. Yes, option number B is the correct one. You can think of it like this. Imagine a person has 50 lakh of black money, right? 50 lakh of black money here. So instead of depositing it all at once, which will be reported, they split into a smaller chunk of 9.5 lakh each and put into different account, sometime using friend or associate or as depositor. This way, they avoid the 10 lakh reporting limit. Later, they transfer or withdraw the money multiple times to make it harder to trace. This clever breaking down is what we call smurfing, or we call it structuring. Option C is using offshore account to invest in legitimate business. So that is called, integration. This describes another layer of stage of money laundering, that is called integration, where money is pushed into legal business, often abroad. That is not smurfing. And option D say, transferring money internationally using bank account. That is closer to the Hawala system, right? This is called, Hawala system, which is an informal value transfer method. Again, not smurfing. So what we learned from this discussion is that, smurfing is breaking big money. You have big money and you break it down into small money, right? And then to dodge the reporting rule, and done using multiple account, multiple people, these people are called, smurf. That's why this process is called smurfing. And frequent transfer. Aim is to hide the money trail and avoid detection by the regulators. Now friends, let's look at the very good question. Which of the following entities are explicitly exempted from the applicability of the PMLA? Very good question, right? So which entities are exempted from the applicability of the PMLA? Option says all financial institutions including cooperative bank and HFC. Option B, commodity future broker and DNFFB. Please remember the full form. Designated non-financial business and profession. Option C, stock broker and merchant banker registered under SEBI. Option D, NBFC. Let's look at option number A. Option number A is wrong. Why? Because cooperative bank and housing finance company do come under PMLA. They have to follow KYC. Option B say DNFFB. Yes, this is the correct answer. These are specifically kept outside the scope of PMLA in India because commodity broker, right? Commodity broker are regulated separately under their own law. And if we talk about the DNFPV, like, can you give me some example of DNF?
Very important. So the options are, it involves two parties exchanging loan in different currency without any collateral. Option B, a money launderer transfer illicit fund to another country as a security for a bank loan, which is then sent back to the original country. Option C, it refers to borrowing fund from multiple banks simultaneously to hide the source of money. Option D, it is a method where criminal proceeds are directly deposited into offshore account without any formal agreement. So these are the options that have been given. Now, which statement correctly describes the back-to-back loan? So option number A, if you look at the option number A, it says that, that two parties exchange loan in different currency without collateral. So two parties are there, right? They exchange loan. Two parties are there, they exchange loan in different currency and no collateral is there, right? It sounds fancy, right? But this is just a currency swap, not money laundering. So this is just a kind of, currency swap, not money laundering. Because if we talk about the back-to-back loan, it involves using illegal money as a security for the loan, right? So that's the point. So not just exchanging currency. Here we are talking about only exchanging currency. That is currency swap. This is not the correct answer. Option number B, yes, this is the real deal. What happened? So friends, option number B, this is the real deal. Suppose a launderer send dirty money to another country. So let me give you one example to understand it. So suppose this is a launderer. What he does, he send dirty money. Where? To another country. Right. He send dirty money to another country. Why? So basically as a collateral, right? And uses the dirty money as a collateral, right? To give a loan in the original country. So now the money looks clean because it came from a bank loan. So imagine, let me give you one example. Imagine you have 10 crore of illegal money, right? So you send it to a foreign bank as security. This 10 crore you have sent to the foreign bank as security, right? So that bank help you get a 10 crore loan in India. Now your money look legal because it came from a bank loan, right? So this is the example of, yes, that is what option number B is correct. What about C? It refers to borrowing fund from multiple banks simultaneously. See, borrowing from multiple banks at the same time, this is called, loan layering. So suppose the question asks about loan layering, then this would be the correct answer. That is called, loan layering, right? But not back-to-back loan. It is another trick, but this is not the correct one. What about D? D says it is a method where criminal proceeds are directly deposited into offshore account without any formal agreement. So, directly putting money in offshore account without agreement, that is just hiding money abroad. So this is just, Now, if you look at the option number D, it says that directly putting money in offshore account without agreement, right? That is what it is all about. So that is just hiding money abroad. It is called, hiding money abroad, right? So, back-to-back loan requires a structured loan arrangement. If you talk about the back-to-back loan, it requires a structured loan arrangement to make the money look legitimate, right? So that is the point. So option number D, if we talk about, so back-to-back loan requires a structured loan arrangement to make the money look legitimate. That's why option number D is also wrong. So what is the correct answer? Correct answer is option number B. So whenever you hear this word back-to-back loan, just think about it. We have dirty money, right? And that dirty money, I have of it like this. You have a dirty money and you have sent that dirty money into the foreign country and you are using that particular money as a collateral for the loan, right? So now that dirty money looks legal, right? It looks clean. So basically this is like, using illicit fund as security for the legitimate loan. So you can think of it like, loan against your own dirty money. Loan against your own dirty money abroad. Loan against your own dirty money abroad. About FATF. What is FATF? Financial Action Task Force, right? So, which of the following statement about Financial Action Task Force membership as of 2025 is correct? So, this is the recent data, right? This is the recent data. Option number A, FATF has 39 members, all of which are individual country. FATF include 39 members, 37 jurisdiction, 2 regional organizations. Option C, FATF membership is limited to country in Europe and North America only. India is not a member of FATF as of 2025. So question is, which statement is correct, right? So if you look at the option number A, so it says that 39 members and all are country. It sounds closing, but it is wrong, right? Because FATF has 39 members. FATF has 39 members, but 2 of them are regional organizations. 2 are regional organizations, right? Let me give you the name like GCC, right? And European Commission. They are the regional organization. They are not the country. But what they are written? They are country. No, all are not country. Some are regional organization like GCC and European Commission, right? They are not countries. They are regional organization. Second point. Option number B says FATF include 39 members, 37 jurisdiction and 2 regional organizations. Yes, this is correct. How many countries are there? 37 countries are there. 37 jurisdiction are there. 2 regional organizations are there. Right. What are the name of 2 regional organizations? Gulf Cooperation Council and European Commission. These are the two regional organizations. So some big names like, USA, like, India, China, UK, France, right? These are the big names. UK, USA, India, China, UK, France, Japan, all are the member. India joined in the year 2010. So option number B is the correct answer. What about C? FATF membership is limited to country in the Europe and North America only. This is incorrect. No way. FATF is global. Member include country from Asia, Middle East, Africa, Latin America. What about India not a member? No. India is also a member. India has been a full member since 2010. Right. So what we learned from this discussion is that sometimes question is asked regarding the number of members in FATF. Total 39 members are there. 37 country plus 2 regional organizations. 2 regional bodies are there. What are the name of regional body? GCC and European Commission. And you can think it like this. 37 plus 2 is equal to 39. And GCC and EC. GCC means Gulf Cooperation Council and ECA means, European Commission. These are 2 extra. I hope that makes sense. Now friends, let's see the next question. Which of the following best describe the non-member of a institution to mitigate risk associated with trust? Very good question it is. Ignoring the identities of trustee and beneficiary. So basically the question is what, why trusts are so much, risky, right? What are the measures? What are the risks which are involved in trust and how to mitigate that? Option A, ignoring the identity of the trustee and beneficiary. Option B, enhance due diligence, including verify all parties and monitoring transactions, allowing trust to operate without documentation, prohibiting trust from holding asset in any jurisdiction. So which measure do you think is correct? So friends, option number A, if you look at, it says that ignoring identity of trustee and beneficiary. This is a big no. This is a big no. Why? Because if you ignore who is behind the trust, you open the door for money laundering, right? If you ignore who is behind the trust, you open the door for money laundering. So that's why it is wrong. What about option B? Option B say enhance due diligence, including verifying all parties and monitoring transactions. Yes, this is the correct one. Why? Because, financial institutions apply enhanced due diligence. That is called, EDD. So they identify the settler. Settler is the person who create the trust. Settler is the person who create the trust. Second thing, they identify the trustee. Trustee is someone who manage the trust. Right. They identify the beneficiary who benefit from the trust. So EDD, that is, financial institution, they identify the settler, they identify the trustee, they also identify the beneficiary. Let me give you one example. For example, let's suppose a trust is there. Right. Suppose there is a trust and that particular trust suddenly move large sum to offshore account. This move large sum to where? To offshore account. Right. So the bank check if it is legal and report if it's required, right? So if a trust suddenly move large sum to offshore account, the bank check if it is legal and report if it is required. Report also done if the report is required, right? So that is the point. What about option C? Allowing trust to operate without documentation. So see, allowing trust to operate without documentation, that is like letting someone open a bank account without ID. That's quite impossible and it is very risky. So it is wrong. What about D? Prohibiting trust from holding asset in any jurisdiction. See, prohibiting trust from holding asset globally, that is unrealistic, right? Trust can hold asset worldwide, but under a strict compliance check. So what we learned from this discussion is that, trust are highly risk. Trust bear high risk, right? High risks are there in the trust, right? So bank do extra check. Bank required to do extra check. In what form? So you need to identify all the parties. When I say party, first thing is identification. Identify. When I say party, that means, you need to identify who is settler, who is trustee, who is beneficiary. Everything have to identify. Second thing to do is to monitor the transaction, right? You have to monitor the transaction. Third thing is to do, you have to follow the AML CFT law. These 3 things the bank has to do. So think of it like this, trust but verify, and verify everyone. Everyone you have to verify, right? So that's why option number B is the correct answer. Now let's look at the next question. Which of the following measure is commonly applied? I think this is a repetition of the question. Let me move to the next question. Yes. Under section 2 WA of the Prevention of Money Laundering Act PMLA, which of the following correctly define a reporting entity? So the question is regarding, PMLA. So PMLA, which of the following correctly define a reporting entity? Options are any individual who conduct financial transaction for personal purpose. Option B, a banking company, financial institution, intermediary, or a person carrying on a designated business or profession. Option C, only bank and insurance company regulated by RBI. Option D, any entity that provide consultancy service without financial involvement. Very good question it is. So what do you think? Out of A, B, C or D, which one? Which correctly define a reporting entity? That is called, RE. This is the question, RE. Right. So let's see the option number A. So option number say any individual doing personal transaction. See, that is wrong because if you send money to your friend or to buy grocery, you are not a reporting entity. PMLA apply to business. PMLA apply to business, not personal transaction. That's why it is wrong. What about option B? Yes, this is the correct one. This include bank, financial institution, intermediary like a stock broker. Right. So some example of intermediary I can give you is a stock broker. And even people running certain business like casinos. Suppose someone is running casinos or real estate. The question is why? Answer is because these sector handle big money and can be misused for laundering. Yes, that is called reporting entity. Right. Option number C, only bank and insurance company regulated by RBI. This is wrong. It is much wider. Think of a stock exchange, mutual fund distributor, even jewelers. They all fall under the reporting entity. Right. You should know who are the entity called reporting entity. So jewelers, mutual fund distributors, stock exchange, they all are called, regulated entity. What about option D? Any entity that provide consultancy service without financial involvement. So consultancy without financial involvement? No way. If you just give advice and don't handle money, PMLA does not apply. So let me give you one example to make it clear. So imagine that there is a jeweler. And that particular jeweler, he is selling gold. He is selling gold worth rupees 10 lakh. So basically that jeweler is, RE, reporting entity. And he must follow the KYC rule. But if you buy a gold ring for 10,000 rupees for your wedding, you are not a reporting entity. Suppose you buy a 10,000 rupees gold for wedding, you are not a reporting entity. So to summarize, we can say, who are reporting entity? Here you can see. Reporting entity includes, first thing, let me highlight, banking company, financial institution, intermediary, person carrying on designated business or profession. These are called reporting entity. Please remember it for the upcoming examination. Short one question will be asked. Right. Please note it down. These are called reporting entity. If you want such kind of PDF for previously held examination, memory based question, you can WhatsApp me on this particular number, or you can see the description section of this video. You will get a link to our AML KYC course, where in addition to such PDF, you get unit-wise theory, unit-wise MCQs covering the entire syllabus of the AML and AML KYC as per the syllabus prescribed by IIBF. Many aspirants have cracked the examination using our material. You can also. So do check our course in the description section. Now, I hope this is clear what is reporting entity. Now let's see the next question. Why do RBI mandate strict confidential regarding the filling of STR? Very good question. What is STR? Suspicious transaction report. That's called STR. Right. So question is, why do bank keep suspicious transaction report a secret? Let's decode it. Options are to ensure customer are informed about investigation promptly, to avoid prejudicing or affecting an investigation by law enforcement agency, to allow customer to correct error in their transaction, to maintain transparency in the banking operation. Right. So option number A, let's start with. Should customer be informed about investigation? Absolutely not. Right. If you tell someone their transaction is suspicious, they might hide evidence or they move money elsewhere. That's why option A is wrong. Option B is the real reason. If a bank discloses STR detail, it can tip off criminal and ruin the investigation. So secrecy protect the process. Right. What about C? Allowing customer to correct error. Sound nice, but STR are about suspicious activity, not simple mistake. So this is wrong. What about D? Transparency is, transparency in banking is good for customer. But if you talk about the suspicious transaction report, it's quite different. Right. So, sharing this information would compromise law enforcement work. So this is also wrong. So let me give you one example to make it crystal clear. So friends, you can think of it like this. Imagine there is a bank, right? This particular bank, it filed an STR. Why? Because it customer, it deposited 50 lakh rupees. Because it customer deposited 50 lakh rupees. right, in cash suddenly. So bank file an STR because customer deposited 50 lakh rupees in cash suddenly. If the bank tells the customer, they might quickly withdraw or hide the money. That's why confidentiality is the key, right? I hope that is clear. So STR detail must never be disclosed to the customer, right? Purpose is to prevent the tipping off and protect the investigation. Records should be kept secure, handled by senior staff, and kept separate from the normal data. I hope that makes sense. Now friends, let's see the next question. Which of the following is a key responsibility of head or staff of processing or operating unit at the corporate or the nodal office under AML KYC guideline? Right. So a very good question it is. It is talking about the responsibility of the, processing and operating unit at the corporate and nodal office. Very important. Right. Option number A is saying designing, marketing campaign for a new banking product. Option number B, ensuring customer due diligence for various type of customer, taking a special care for high risk. Option C, approving all loan application personally. Option D, handling customer grievance exclusively. So if you look at the option number A, so it is talking about marketing campaign. Do you think that's for marketing team, not the compliance officer? Here we are talking to the context of compliance officer. So AML KYC is about, preventing money laundering, not selling the product. That's why option number A is wrong. Option B, this is the real job. They check customer identity, right? They check the customer identity, first thing. They also check the customer risk level. What is the risk level of customer? They make sure that high risk product or high risk location get extra scrutiny. Plus they flag any suspicious case for investigation. You can see clearly they have mentioned and define the suspicious case, right? They flag any kind of a suspicious case for, investigation. What about option C? Approving all loan application personally. No, that is wrong. Why? Because that is an operational task, not compliance responsibility. So if you approve all loan application personally, that is operational task. That is what task? That is operational task, right? That is not compliance responsibility. What about option D? It says handling customer grievance exclusively. So we're talking about handling complaint. It is quite important, but that customer service, not AML KYC compliance. So this is wrong. What about C? This is also wrong. So let me give you one example. Let me give you one example to make it more clear. Suppose there is a customer. He want to open an account, okay, and deposit 50 lakh rupees in cash. There is a customer who want to open an account and deposited 50 lakh rupees in cash. The compliance team ensure that proper KYC, right? The compliance team should ensure proper KYC, right? Check if the customer is high risk. Compliance team will check if the customer is high risk and monitor for any suspicious activity. They don't design, add or approve the loan, right? This is the point. This is how it works. So what we learned? Customer due diligence. This is called CDD. This process is called, CDD, customer due diligence, right? For all the customer. Extra care, high risk product, channels and locations. And they have to detect suspicious transaction for review. So the next time you think compliance is just paperwork, remember, they are the watchdog keeping the system clean. Okay, now let's see the next question. The next question we have is, which of the following is a common indicator of trade-based money laundering in banking operation? So this is called, TBML, trade-based money laundering. So indicators these have been asked. Options are: customer provide complete and clear documentation for all transaction. Option B, inward remittance is immediately withdrawn or transferred from account without business justification. Option C, advance payment strictly follow a standard trade practice. Option D, letter of credit contain a standard clause with no amendment. So if you look at the option number A, it's talking about, complete documentation. That is a normal and good practice. Nothing suspicious here, right? There's nothing suspicious. This is normal and good practice. So this is not a money laundering. So this is not the answer. Option B, yes, this is the correct one. This is a warning sign. Why? Because if money comes in and immediately move out without a clear trade reason, it could mean layering or hiding the fund. It could mean two things. Either you are, see what is happening, suppose this is our system, right? This is our system. Now money is coming in, this is the account, money is going out of the account, right? Immediately moved out without a clear trade reason. There is no trade reason, right? So this clearly indicates, either it means layering or it could indicate hiding the fund, right? So yes, option B is the correct one. What about C? C says, advance payment strictly follow standard trade practice. That is expected and safe, right? So that is not a money laundering. And letter of credit contain a standard clause with no amendment. So a standard letter of credit are fine. The problem is when letter of credit are repeated amendment or unusual clauses that raise suspicion. Suppose there is some unusual clause in the letter of credit. Obviously, it will raise suspicion. Let me give you one example to make this crystal clear. What is this TVML all about? So obviously, you can expect a question on TVML in the upcoming examination. So let's make it more clear. Suppose that there is a company. This is a company, right? And this particular company has received 1 crore from abroad. From where? Abroad. From abroad, it has received 1 crore and instantly transfer it to another account. It instantly transfer it to another account without buying or without selling goods. It does not buy without buying and without selling the good, right? So that is not normal trade behavior. It's like, classical TVML indicator. This company, it bought goods, it received 1 crore from abroad, instantly transfer it to another account without buying, without selling the goods. That is not normal trade behavior. It's a classical TVML indicator, right? So this is a classic example of TVML indicator. So let me explain. So account open for advance remittance and close quickly. Right. This is a like TVML red flag. We can call it, TVML red flag. Suppose you open an account, right? Open for advance remittance and you can quickly close it. Advance amount not matching trade norms. Vague goods description or missing detail in the wire transfer. Repeated amendment in LC without reason. And payment against very odd bill or repeated import export of the same item. Right. So these are called, red flag. Please note it down. These are called red flag. So let's summarize the key points. What we learned about TVML. Here we can see TVML, using trade transaction to hide the illegal money. That's called TVML. That is a trade-based money laundering. The first T stands for trade. You are using trade transaction. Why you are using trade transaction? To hide the illegal money. Main indicators. What are the main indicators of TVML? Here you can see. First of all, quick withdrawal, immediate withdrawal. This is one indicator. Then we have transfer of inward remittance. This is another indicator. Another sign can be, suspicious document, right? Another sign can be suspicious document or, unusual LC amendment. Unusual LC amendment or, vague good details. These are another amendment. So the next time you see money moving fast than goods, think about TVML. Suppose the next time you see that money is moving fast as compared to goods, you think about TVML, right? TVML means trade but money laundered. That is how you can remember it. Now friends, let's look at the next question. What is the reporting timeline for a CTR under PML rule? CTR, cash transaction report. What is the reporting timeline? Within 7 days of transaction, by the 15th of the next month, quarterly by 30th of the next month, immediately after transaction. So what do you think about, reporting timeline? The question is asking you about reporting timeline for a CTR. So if you look at the option number is 7 days, no, that is wrong. Why? Because, CTR is not immediate, it's monthly. What about option B? Yes, this is the correct one. CTR must be reported to whom? It must be reported to FIU INDR, Financial Intelligence Unit India, FIU India. By when? By the 15th of the next month. What about C? It says quarterly by 30th of the next month. This is wrong. Quarterly wrong. Because, CTR is always monthly. CTR is never quarterly. And what about D? Immediately? No. That is for urgent alert, not CTR. So suppose if a bank see that, there is a cash deposit more than, there is a cash deposit more than 10 lakh in November. So it must report them by the 15th December. That's it. Suppose if a bank see that, cash deposit above 10 lakh in November, it must report them by 15th December. I hope that makes sense. So remember, CTR means, it covers cash transaction above 10 lakh. Let me highlight it. All the cash transaction above 10 lakh. That's why it is called, CTR. What is the full form? Cash transaction report. So it always deals with cash. Or it may be, series of connected cash aggregating to 10 lakh or more. Periodicity is monthly. Timeline by the 15th of the following month. Just remember it. Next question is regarding STR. When should an STR be submitted to FIU IND? STR, is called suspicious transaction report. Option A monthly, option C within 7 days, option C quarterly, option D at the end of financial year. So what do you think? Option A monthly? No. STR is not monthly, STR is a periodic. Option B is correct.
Option B is correct, right? Let me highlight it. Yes, option B is correct. Why? Because as soon as you identify suspicion, report it within 7 days, right? What about C and D? No, no, no. That too late. Suppose a bank find a customer moving fund strangely, right? Suppose a bank find that a customer is moving fund strangely, right, today. So it must report within 7 days. It will not wait for, no waiting for month end. So remember, STR apply to any suspicious transaction. Either it can be cash or it can be non-cash. While CTR only apply for cash. Right. Timeline is within 7 days. That's it. Just remember it. Right. Now, next question. CCR. Which transaction require a counterfeit currency report and what is its reporting timeline? Option A, all foreign currency transaction reported immediately. All cash transaction involving counterfeit note reported monthly. All suspicious transaction reported quarterly. All high value transaction reported annually. So this question pertains to, CCR. That's called, counterfeit currency report. That is called CCR. So friends, which option do you think is correct? So let's look at each and every option. Option A say, foreign currency. But it is wrong. It is wrong. Option A is wrong. Why? Because CCR is about fake notes. Remember, it does not include foreign currency. If I say CCR, just remember it. Let me erase it. Yes. So if I say CCR, you must remember it. This is about, fake currency or fake notes. Just remember it. What about option B? Option B is correct. Why? Because, if counterfeit note are detected, report monthly by 15th of the next month. Right. If you detect any counterfeit note or forgery, report it by 15th of the next month. So friends, just remember this CCR and CTR. They follow the calendar. They follow the calendar. What about STR? So STR, they need speed. That means weekly and they are monthly. This way you can remember it. Now let's have the next question. Which of the following is a key responsibility of the head and staff of business or product unit under AML CFT guideline? Yes, very good question. They are talking about business and product unit. Option A, approving all customer transaction personally. Option B, including AML CFT aspect in product paper and SOP and identifying high risk business line. Option C, handling customer grievance exclusively. Option D, designing market campaign for new banking product. Right. So this is the question. They're talking about, head and staff of the business or product unit. What about option A, approving all customer transaction? So it is impossible. This is not their job, right? What about B? Yes. They make sure that, AML and CFT rules are being built into product paper and SOP, standing operation procedure, and, standard operating procedure, and identify high risk area for extra monitoring. Yes, that is their role. That is the role of the head and staff of the business or product unit. What about C? Grievance, right? No. That's customer service, right? Not compliance. Here we are talking about, compliance. That's customer service. What about option D? Marketing campaign. So that is for marketing team, not compliance officer. So for example, suppose you are launching a new product like a prepaid card. Suppose you are launching a new product like a prepaid card, right? So the business unit, they must include AML check. Business unit must include the AML check in the SOP and flag if the product is high risk. They should flag. They should flag when they should flag when the product is at high risk. They should flag it, right? So remember the key points. Embed AML CFT in the product design and SOP. Identify high risk business line and customer groups, right? So these are the two things. So I hope it is clear. Now let's look at the next question. Which of the following tasks fall under the role of head and staff of the processing? See, just now we are talking about head and staff of the business processing unit, right? Business or processing or operating unit. So which of the following tasks falls under the role of head and staff of the processing and operating unit at the corporate or nodal office? Option A, conduct media research. Option B, customer due diligence for various customer type. Option C, drafting AML CFT clauses for product paper. Option D, approving marketing budget. So what about A, media research? That is for investigation team, not the operation. Here we are talking about the operating unit. You can see written here, right? What about CDD? Yes, this is the correct one. They handle KYC. They apply extra check. They apply extra check for high risk customer. And they flag any kind of suspicious transaction is there, they flag it. So three things they do: KYC check, extra check for your high risk customer, and flag any suspicious transaction. That's why B is correct. What about C?
C says, drafting AML CFT clauses for product paper. So that is for, product unit. Just now I have told you in the previous question. So previous question was about, product unit. Here we are talking about the operating unit. Understand the difference, right? Product unit, they draft AML CFT clauses. But if you talk about the operating unit, they don't draft it. Rather, what they do, they handle KYC, right? What about option D, approving the marketing budget? That is totally unrelated. Let me give you one example. Suppose there is a customer, right? He want to open an account, and suppose there is a customer, he want to open an account, and he deposited 50 lakh in cash. So what operation staff will do? They must verify the identity, apply enhanced check, and escalate if it is suspicious. That is called, customer due diligence. It is done for all the customer. Extra care for high risk products, channels, and location. So let me just summarize two things we have just discussed. So business unit, right? Business unit, they build AML. Remember, they build AML into product. And operating unit, they apply AML on the customer. Please understand the difference. These things are very, very important. This has been taken from your Macmillan book. And this thing will not be written in your book. This is the way to remember. Business unit means they build AML into product, and operating unit means they apply AML on the customer. I have given you two examples to make it clear. So think of it like this way. Business unit design the rule, operating unit enforce them, right? Who designed the rule? Business unit. Who enforce them? Operating unit. This way you can remember the function of business unit and operating unit. I hope that makes sense. Now friends, let's see the next question. So if you really think that this video is helping you, giving value to your preparation, please hit that like button. Question is, can foreign student open any bank account in India? Let's have a look. Which of the following correctly describe the requirement and restriction for opening of account for foreign student coming to India? Option A, foreign student can open a resident saving account with no restriction. Option B, they can open an NRO account by providing passport with visa, photograph, and admission letter. They open any account type without address verification. They can open an NRO account without any transaction limit during the first 30 days. So if you look at the option number A, it's talking about, resident saving account. Do you think they can? No way. Foreign students are non-resident. So they can't open a resident account. So option A is wrong. What about B? B says they open a non-resident NRO account by providing passport with visa, photograph, admission letter, local address must be declared within 30 days, and pending verification. Inward remittance is limited to $1,000 and monthly withdrawal to $50,000. Yes, correct. They need to provide this passport with visa, photo, admission letter. They must declare their local address within 30 days. 30 days, right? And inward remittance is capped at $1,000, right? That is the inward remittance, and monthly withdrawal at 50,000 rupees. Yes, this is the correct one. What about C? They can open any account type. No address verification. Resident without address verification. That is against the KYC norm. Every account needs proper address proof. What about D? They can open an NRO account without any transaction limit. No transaction limit? No. Open a bank account for a partnership firm. So options they have given is certificate of incorporation, board resolution, PAN of director. B say registration certificate, partnership deed, officially valid document of the person holding power of attorney. C says GST certificate, MOA, AOA, and list of shareholder. D say trade license, shop establishment certificate, and electricity bill. So very good question it is. Let me explain. Whenever a partnership firm want to open a bank account, the bank must verify three things. It consists of how the business will run. It consists of the profit sharing ratio. It consists of the right and responsibility. So the first thing that, partnership deed consists of is the partnership firm legally formed. So if the firm is registered, not compulsory to be registered, if the firm is registered, then bank also required the registration certificate, right? Suppose the firm is registered. I told you partnership firm need not register compulsory, but if it is registered, then registration certificate bank also asks for. So these two documents confirm the identity of the firm, right? The first one is, I told you, is the partnership deed. Second thing I told you, registration certificate. Now so let's see the option that we have. So registration certificate, partnership deed, and now who is allowed to operate the bank account? A partnership firm cannot sign document by itself. So partner gives signing authority to a person, usually through a power of attorney. Here you will see the word they have written, power of attorney. So the partnership firm cannot sign document by itself. So what partner do? They give signing authority to a person, usually through power of attorney. And bank must verify the identity of the authorized person using OVD. There is something called officially valid document, using which what bank does, bank verify the identity. Using OVD, bank verify the identity of the authorized person. So what can be the OVD? Aadhaar can be OVD, right? A passport can be OVD, right? Sometimes driving license can be OVD, voter ID can be OVD, Narega job card can be OVD, but PAN card is not an OVD. So OVD provide identity plus address of the person running. Now let's look at the option. Option number A is a certificate of incorporation, board resolution. Actually, these documents are for company, not for partnership firm. Option B is the perfect one. Registration certificate, partnership deed, OVD of the person holding power of attorney. Option C says GST certificate, MOA, AOA. No, that's wrong. These are also for a company, right? These are also for a company. So C is wrong. What about option D? Trade license, shop establishment certificate, electricity bill. Yeah, this may be supporting document, but not mandatory certified document. So this is also wrong. So the correct answer is option number B, right? So one way you can remember it like this. Just remember the one FIRM, firm. Firm means formation proof. Formation proof is the partnership deed. I means identity of the firm, which is the registration certificate. R means representative ID, which means OVD of the person holding power of attorney. And M means mandate to operate. Mandate to operate, which is power of attorney, which is implicit in option number B. Right, so FIRM, just remember this is a trick to remember what are the documents which are required for opening a registration certificate. F means what? Formation proof. And how will you get the formation proof? Yes, you are thinking correct. This is our, to get the formation proof, you take partnership deed. And I for identity, right, of the firm, which you can get by registration certificate. R for, representative ID, which is OVD of the person. And last M is for mandate. I hope this is clear. Now let's look at the question number 2. Exactly same question was asked in the examination. The question is, which of the following is not a responsibility of the board of directors? Yes, this question pertains to responsibility of the board of directors in respect of the bank obligation under PMLA. So not a responsibility of the board of directors they have asked. Option A say ensuring that bank has a KYC policy aligned with the legal and regulatory stipulation. Option B approving and overseeing an effective AML CFT framework. Option C conducting day-to-day customer due diligence, that is called CDD, check at the branch level. And option D, it says appointing the designated director as required under PMLA. So which is not a responsibility they have asked. So now to understand this question, remember the simple idea. Let me tell you the simple idea that you must keep in the mind about the responsibility of the BOD. The first thing is that board always set policies, right? And branches, what branch do? Branches do day-to-day work. Right. So under PMLA, Prevention of Money Laundering Act, and RBI guideline, the board of directors plays only policy level and supervisory role. Policy level plus supervisory role. Let's break down each and every option. Option number A say ensuring that bank has a KYC policy aligned and review it. Yes, correct. This is the board responsibility. Obviously correct. Right. The board must ensure that bank has a proper KYC policy and follow all the law and RBI rule. What about option B? Approving and overseeing AML CFT framework. Yes, this is also correct. Why? Because the board must approve the bank anti-money laundering and combating the financial terrorism. What is CFT? That is called combating the financial terrorism. They must ensure risk categorization, monitoring system, reporting mechanism. So these things must be ensured. Risk categorization, then monitoring system, then reporting mechanism. These things must be ensured. Option B is also correct. What about option C? Conducting day-to-day customer due diligence check at the branch level. No. This is not a branch level, board level responsibility. Right. So daily tasks like verifying documents, checking customer identity, updating KYC, they are done by the operation staff, branch officer, compliance team, not by the board. Right. And what about option D? Appointing the designated director. Yes, correct. Under the PMLA rule, bank must appoint, the board of director, BOD must appoint a designated director who ensure that, what is the role of DD? DD ensure that bank is following the AML KYC, right, regulations or not, right? So they ensure. So yes, ABD are the function, but C is not the function, right? So this is the correct answer. So one way you can remember it like this: board is the boss level, right? Board is the boss level job. They make policy, they approve framework, they appoint key rules. But branch level, branch is the work level. Board is the boss level, branch is the work level. Branch is just the daily CDD check and customer handling. So just remember, if it happened daily, and it is never the board job, right? Whatever is happening daily, it is never the board job. This way you can eliminate the option. Friends, if you are looking for perfect study material for AML, KYC and CFT for certification examination, you can WhatsApp me on this particular number. We have more than 6 to 7 previous year memory based question, and each paper consists of 30 to 40 question. So almost it is a set of 200 to 300 question. If you go through those set, surely you will get similar question, similar concept based question in the examination. In addition to that, we provide you capsule notes, module wise important, also unit wise theory and MCQs PDF, which cover the entire syllabus at an affordable rate you can get. You can install our app. The link is provided in the description section. Now friends, have a look at the next question. The question is, which of the following statement about Wolfsburg Group is not correct? Question is not correct, right? So options they have given, right? The Wolfsburg Group is a voluntary association of major global bank focusing on development of AML CFT industry standard. Option B, the Wolfsburg Group operate as a regulatory body with legal enforcement power. Option C, the Wolfsburg Group issue non-binding guidance such as Wolfsburg Principle and CBDDQ. Option D, the Wolfsburg Group collaborate with international bodies like FATF but remain private sector led. So which option do you think is not correct? So if you look at the option number A, it says, first of all, this is if we talk about this Wolfsburg Group, just remember it. This is the group of big international bank. This is the group of big international bank that came together voluntarily. Right. What is the main goal? Their main goal is to improve the global practice. Their main goal is to improve the global practice in AML and CFT. That is the main goal. To improve the global practice in AML and CFT. So yes, they are industry led, not government led. Please remember, they are never government led. Clearly written, right? They are industry led. They are not government led. So I think option number A is correct. What about option number B? It says they operate as a regulatory body with legal enforcement power. No. This is wrong. Actually, Wolfsburg Group is not a regulator. It cannot issue law. It cannot fine bank. It cannot enforce penalty. It cannot force compliance. It is simply an industry consortium. Remember, it is simply a industry consortium, right? That provide best practical guidance. That provide best guidance possible, not legal rules. So that is why option B is the correct answer. Because the question is asking not correct, right? So this option B is the not correct one. What about option C? It says that it issues non-binding guidance such as Wolfsburg Principle and CBDDQ. Exactly correct. Wolfsburg Principle and what is CBDDQ? What is this? This is basically correspondent bank due diligence questionnaire, right? So these are, guidance document. These are, guidance document. They improve global compliance standard, but following them is not mandatory. There is no mandatory. Yes, this is the correct one. And what about option D? It says that they collaborate with international body like FATF, but remain private bank led. Yes, very good. It is correct one. Because Wolfsburg Group, they work with Financial Action Task Force. They work with Basel Committee. They work with other international bodies, but still it is private sector group, not a government entity. So the final answer to this question is, you are thinking right, that's option number B, right? So let me just give you a trick to remember it. Whenever you see this word Wolfsburg, whenever you see this word, just think about it wisdom. This is think about it wisdom, not weapon. Wisdom, not weapon, right? So wisdom means they give guidance, they give principle, they give questionnaire, not weapon, which means they cannot punish, enforce or regulate, right? That's why I told you, think of them like a wisdom. Wisdom means, they will give guidance, they will give principles, they will give questionnaires, and not weapons means they cannot punish, enforce or regulate. So if you see, so friends, you can remember Wolfsburg as a wisdom, not weapon. So wisdom is they give guidance, they give principle, they give questionnaire, but they cannot punish, they cannot enforce, they cannot regulate, right? So if you see anything saying that Wolfsburg has a legal power, that is automatically wrong. Now have a look at the third question. So the next question is, which of the following statement regarding KYC activation and reactivation of the dormant or inoperative bank account is not correct? Again, please highlight this word not correct, right? So first of all, options are: a dormant account can be reactivated after obtaining fresh KYC document like OVD or simplified KYC document. B says if there is no change in the address and KYC is already complete, the bank may allow self-declaration along with PAN for updating KYC. Option C say that KYC updation for dormant account can only be done at the home branch where the account was originally opened. Option D say bank may use video KYC or authorized business correspondent to update KYC for dormant account holder. So friends, if you look at the option number A, I think this is the correct one. This is the correct one. Why? Because if the customer old KYC document are outdated, invalid, missing, the bank may ask for, updated KYC. The bank may ask for updated OVD, right? Or valid simplified KYC document. Or valid simplified KYC document. So if the customer old KYC document are outdated or invalid, so what will bank do? The bank may ask for updated OVD or valid simplified KYC document. This is fully allowed. Option B says self-declaration plus PAN. If there is no change in the address and KYC is already complete, bank may allow self-declaration along with PAN for updating KYC. Yes, this is the correct statement. Why? Because RBI allow an easy process that if the customer address has not changed and earlier full KYC is done. So two things are there. No change in address and full KYC is done already. The bank can accept a simple self-declaration and PAN for updating KYC. No fresh document is required. That is the part of RBI KYC easing measures. What about option C? It says that KYC updation for dormant account can only be done at the home branch where the account was originally obtained. No, this is incorrect. Actually, KYC update can be done at any branch, right? It can be done at any branch. No need to visit the branch where the account was originally opened. This applies to normal account as well as the dormant account. That's why option number C is the incorrect one. What about option D? Bank may use VCIP, that is video based KYC, customer identification process, or BC is business correspondent to update KYC for dormant account. Yes, this is the correct one. Because RBI now allow bank to update customer KYC through video KYC or authorized BC. This makes the process easier for customer. So this is the correct one. So the question was which is not correct. So obviously option number C is not correct. That is the final answer. So just remember this keyword KYC, any branch, any channel, right? KYC means any branch, any channel. Means any branch, no need to go to home branch. You can use VCIP or BC, anything. So dormant account can be reactivated after fresh KYC if needed. And if address is unchanged and KYC is complete, so self-declaration plus PAN will work and KYC updation can be done at any branch. Bank can use VCIP plus business correspondent for KYC update. Now have a look at the next question. Very important question asked every examination, asked every attempt. So the question is which of the following statement regarding the opening and operation of the NRO account for foreign student in India is not correct? Very good question. So the question pertains to opening and operation of the NRO account for foreign student in India. So which is not correct, they have asked you. So option A says that a foreign student must submit a passport with visa, immigration endorsement, a photograph and an admission letter from an Indian educational institution to open the account. Option B say that, so here the keyword are passport, you can see passport, visa, immigration endorsement, photograph, admission letter, etc. Option B says must give local address within 30 days. Right, declaration of the local address within 30 days of account opening. Option C says unlimited foreign inward remittance allowed before address verification. You can see written unlimited foreign inward remittance, right, is allowed before address verification. And option D say Pakistan or Bangladesh national need RBI approval. Right, they require prior RBI approval, Pakistan or Bangladesh national. So let's see which option is correct. If you go through option number A, you can see that this is the correct one. Yeah, right. To open the account, a foreign student must give what? To open the account, a foreign student must give passport with visa, immigration stamp, recent photograph, admission letter from the Indian educational institution. This is the correct one. The question is not correct. Right. So they have to give the passport, they have to give the recent photograph, admission letter from Indian education institution. Option B says that must give local address within 30 days. What do you think? Yes, this is the correct. Because a student may not have a permanent local address at the moment of arrival. So temporarily RBI law temporarily address at the basically RBI law temporary address at the account opening and local address declaration within 30 days. This is the correct one. Right, but bank must verify this address later. Bank must verify this address later. Now what about option C? Option C says, pending verification of the local address, that it says, unlimited foreign inward remittance. This is not correct. This is the wrong. The truth is that, before the local address is verified, the student cannot receive unlimited foreign remittance. After it is verified, then they can receive. Right. And, RBI limit foreign remittance to how much? $1,000. Right. Until the address verification is done. and also withdrawal are capped at 50,000 rupees per month, right, until the address verification is done. So this word unlimited inward remittance is incorrect. What about option D? It says Pakistan, Bangladesh nation need RBI approval. Foreign student who belong to Pakistan or Bangladesh, they must take prior RBI approval. This is the correct one. This is the mandatory rule. So just one trick to remember it. 1 to 50 rule for a student, right? So you can remember it like this. So friends, this is called 1 to 50 rule for a student. So what does it mean? So before address verification, right, which means $1,000 maximum foreign remittance, and 50 means 50,000 rupees withdrawal limit, right? So this is the limit, please remember it, right? Now friends, let's have a look at the next question that we have. So this is a fill in the blank type question, very good question. So it says that under the PMLA rule, that is Prevention of Money Laundering Act rule, bank must report first, right, all the cash transaction exceeding dash in a single instance, and second, all series of integrally connected cash transaction occurring within 1 month where aggregate value exceed 1. So there are two blanks, first and second option. They have given you 2 lakh, 5 lakh, 10 lakh, 10 lakh, 50,000, 2 lakh, 5 lakh, 10 lakh. So what do you think is correct? Let's have a look. Under the Prevention of Money Laundering Act and the Maintenance of Record rule, under both these rules, bank must file a CTR, right? So bank has to file what? CTR. With whom? Bank has to file a CTR with FIUIND, right? So there are two situations where CTR must be filed. The first case is single large cash transaction. Single large cash transaction. So if any of the customer does a single cash transaction of more than 10 lakh, right, the bank must report it. That has to be reported, right? So for example, suppose if someone deposited 11 lakh in cash in one go, right? So CTR must be needed. And the second case is, basically multiple small cash transaction. Suppose there are multiple small cash transactions. Suppose if a customer does many small cash deposit, many small cash withdrawal, all within the same month, and they are related, integrally connected, and the total crosses 10 lakh, it must be reported. Let me give you one example. Suppose 3 lakh he has deposited today, right? 4 lakh he has deposited next week, right? 3.5 lakh he have deposited in the month, later in the month, later. So total is how much? 3 plus 3.5 plus 4, which is 10.5 lakh. So in this case also, CTR must be filed. Although each is below 10 lakh, you can see 3.5, 3, 4, each one of them are below the 10 lakh, but together they cross the limit. That is exactly why the correct value for both the blank is 10 and 10. So here also we will write 10 and here also we will write 10. In both the cases, CTR has to be filed, cash transaction report has to be filed. So 10-10 rule for cash reporting. 10 lakh single, report. 10 lakh total in 1 month, report. If it is 10 or more, FIU needs to know it, right? I hope this is crystal clear. Now, in the last examination, there was a case study which was asked based on STR, suspicious transaction report. And the same case study I have framed before you for your practice purpose. Let's have a look. So the case study, the branch of XYZ bank, branch noticed that there is an unusual rapid movement of fund, right? And branch escalate to the principal officer on 3rd March. Branch escalate the matter to the principal officer on 3rd March. After reviewing, the PO, that is principal officer, conclude on 6th March that the transactions are quite suspicious. Now the question is, by when should the bank submit the STR to FIUIND? So option asks, within 7 days from the date of date the branch detected the activity. Option B, within 7 days from 3 March, that is the date of branch escalation. Within 7 days from 6 March, date PO concludes suspicion, and by the end of the same month. Very good question, right? So, under PMLA and as per the RBI guideline, what is the timing of the STR? So this is, STR. STR means suspicious transaction report. So, the timing of STR depends on one key moment. So that says that the clock starts when the PO forms suspicious, right? Suspicion, not when the branch detects it. When the timeline starts when the PO forms suspicion, right? Not when the branch detects it. So let's break the timeline. So 3rd March, what has happened on the 3rd March? This is the timeline. So 3rd March, what happened? That this is the initial detection. This was the initial detection, right? The branch cannot file STR by itself. It must escalate to the PO. And that is what it has done. It has escalated to the principal officer. Then principal officer review it. Then the 6th March. This is the very important date. So RBI rule says that, STR must be filed within 7 days from the date when the bank arrive at a conclusion that the transaction is suspicious. And who made the conclusion? the conclusion is made by no other than the PO. PO is the principal officer. So the 7-day countdown will start from when? It will start from 6 March, right? Not the 3rd March. Many people get confused here. It will start when the principal officer concluded that yes, truly, this particular transaction is suspicious. So the deadline is, friends, 7 days from 6 March is the correct answer. So which option do you think is correct? Yes, option number C is the correct one. Within 7 days, it has to report from the 6 March to FIUIND, right? So STR means suspicion triggered by reviewer, right? Trigger date and reviewer. Who is the reviewer? PO. PO is the reviewer who decides the date, who decides whether it is suspicious or not. Now the second question of the same case study is like this. The compliance team draft an STR but provide a vague description in the ground of suspicion that customer activity look unusual, hence STR file. The PO is reviewing this draft before submission. So the question is, which of the following action is most appropriate, right? So the compliance team draft an STR, but the ground of suspicion says only that, customer activity look unusual, hence the STR is filed. This is quite vague. This is quite incomplete. The principal officer must review this before submission. The question is, what is the most appropriate action? Option A says that, you should accept the GOS because STR filing is more important than detail. B said that we should reject the STR because vague GOS invalidate the report. C says that return to the team to rewrite GOS clearly, explaining why the activity lack economic rationale. Option D, file the STR and send a separate email explaining the suspicion. So, what is the correct answer? It is very simple, You can think of this GOS, right? That is called, ground of suspicion. You can think of GOS as the heart of the STR. This GOS, you can think of it like, heart of STR, right? FIUIND does not just want to know that something was unusual. They want to know why it was unusual. Why it was unusual. They don't want to know that something was unusual. They want to know why it was unusual. So the good GOS must answer the 4 basic questions. A good GOS, which means, ground of suspicion, they must answer 4 questions. First thing, what happened? Second thing, why suspicious? Third thing, what lack economic logic? What lack economic logic? And the fourth thing is, why does the bank feel it need to report? Why does the bank feel it need to report? Right. So these 4 questions the GOS must answer. Means what happened? Second, why it is suspicious? Third, what lack economic logic? Fourth, why does the bank feel it need to be report like this? So a line like, it is just writing that, customer activity look unusual. A line like this, it gives 0 useful information. That's why PO must send it back for rewriting. Yes. So what PO will not accept? Option A say it will accept. Right. Reject the STR because vague GOS invalidated. No. Option C is the perfect one. Return to the team to rewrite GOS clearly. Right. So PO must ensure clarity, completeness, a specific description, and economic or logical reasoning behind the suspicion. Right. Option A is wrong because they say accept vague GOS. No. Filling quickly is important, but filing properly is more important. Right. That's why this is wrong. Now the final answer is GOS means, give original story. This way you can remember. Give original story. Right. This way you can remember it. So GOS is the most important part of the STR. It must clearly explain why activity is suspicious. Vague line like, activity unusual are not most important part of STR. It must clearly explain why activity is suspicious. Vague line like, activity unusual are not acceptable. Now the third question of the same case study is like this. That a bank detect a suspicious pattern involving online non-cash suspicious transfer. Non-cash suspicious online transfer. Typically used for layering across many account. Right. Multiple account. The branch asks that STR required. There is no cash involved. The PO planned to file the STR using FIUIND utility. Which statement is correct in this scenario? Option A says that STR must be filed. STR is not required because transactions were non-cash. B says that STR must be filed because suspicious apply regardless of cash or non-cash. C says STR can only be filed manually. And D says STR is filed only if monthly value exceeds the threshold of 10 lakh. So the biggest confusion is many branches that, is STR only for cash transaction? Right. This is one of the biggest confusion. That is STR. The question is STR only for cash transaction? There is a PMLA rule 3 subsection 1D. So it says that, STR must be filed for any transaction. Not necessarily cash transaction. Any transaction that is suspicious. Whether it is cash, whether it is online transfer, whether it is NEFT, RTGS, IMPS, right? Or whether it is internal transfer, right? Or whether it is forex transaction, card transaction, etc. Cash is not required for suspicion, right? So cash is irrelevant. So in this case, even though the transfer are purely online, the pattern look like layering. As you can see clearly, they have mentioned that this particular pattern, it looks like, layering, right? You can see involving layering of account. So pattern looks like layering. So which is one of the classic sign of money laundering. So STR must be filed. Which option do you think is correct? Yes, option number B is the correct. Whether it is 1 lakh or 1 rupees or 1 crore, cash or non-cash, in or one transaction or many transaction, if it is look unusual, if it is look unjustified, if it is look, without economic purpose, connected to layering, STR must be filed, right? So please remember it. Now have a look at the next question. Which of the following statement regarding UK sanction as described in the passage is not correct? Which of the following statement regarding the UK sanction as described in the passage is not correct? Option they have mentioned is that, UK and EU impose arm and weapon embargoes on several countries. B says trade sanction issued by UK post prohibit certain trade activity with countries like Lebanon and Syria and Iran. The UK sanction list of prohibited individual entities managed by Financial Conduct Authority. And D say transaction with individual or entity listed under UK sanction are strictly prohibited. So let's break this down one by one. So option number A, that says that UK and EU impose arm and weapon embargo on several countries. This is the correct one. UK and the EU do not put ban on sending arms and weapon to many countries. This is basically they do put ban, right, on sending arms and weapon to many countries. This is basically a type of security measure, right? Don't sell weapon to risky places. Correct one. Option number B says that, trade sanction issued by UK prohibits certain trade activity with the country. Correct. UK also has trade sanction on countries like Lebanon, Syria and Iran. Meaning you cannot do certain business or trade with these countries. So this B is also correct. C says, UK sanction, this is a tricky one. Its sanction list of prohibited individual entity is managed by FCA. Actually, many aspirants think that FCA manage the sanction list. You know what is FCA? Right, FCA, many aspirants think that, the sanction list is managed by FCA. Right, FCA manage the sanction list. So what do you think? Is it correct? So actually, that is wrong. Because, UK sanction list is managed by HMT. Who manage the UK sanction list? See, sanction list is managed by HMT. HMT stands for, Her Majesty Treasury. Her Majesty Treasury, not FCA. FCA do not mention the sanction list, rather HMT manage it. FCA only give financial regulation. What FCA does? It only give financial regulation, right? So it does not maintain the sanction list. So what is the correct answer? So if you look at the option number C, it says UK sanction list of prohibited individual. No, that's wrong. And what about option D? Transaction with individual or entity listed under UK sanction are strictly prohibited. Yes, if someone is on the UK sanction list, you cannot deal with them. No transaction, no business. Correct. So the correct answer is option number C. Right. That is our main learning from this particular question. So you can remember it like this. Sanction list. There is a way to remember it. Sanction list is equal to treasury list. Right. So FCA regulate, treasury sanction update. Just create this rhyme. FCA regulate, treasury sanction update. FCA financial rule, HMT sanction list. I hope it is crystal clear. So UK and European Union impose arm and embargoes. Correct. Trade sanction with Lebanon, Syria and Iran is obviously there is a sanction. And sanction list managed by HMT. FCA does not manage it. Now friends, have a look at the next question. The next question is, which of the following statement about the collection account is not correct? They are asking about the collection account. So option they have mentioned that, collection account used by immigrant. Here you can see used by immigrant group to pool a small deposit and send fund home in single overseas transaction. B says, a foreign account may receive payment from many unconnected account in the home country. C says that collection account are always illegal because these are mainly used for laundering illicit fund. D says criminal group may misuse collection account even though they are legitimate for migrant worker. So which is not correct, they have asked you, as you can see clearly highlighted. So if you look at the statement number A, the passage clearly says that, immigrant worker deposit a small amount into collection account and then the total amount is sent abroad in one single transaction. This is a legitimate method widely used by migrant communities. So yes, what happened, let me show you. Basically, what happened, there are some immigrant worker, right?
So what this immigrant worker they are doing, they are depositing a small amount. They are depositing a small amount where? They are depositing a small amount into the collection account. They are depositing a small amount into the collection account, and then the total amount is sent abroad. Total amount is sent abroad, right, in one single transaction. This is a legitimate method. So option number 1 is legitimate. What about option number B? If you look at the option number B, it says that a foreign account may receive payment from multiple unconnected account. Yes, this is a common feature of collection account, is that foreign account receive deposits from many different people. Often they are unconnected to each other. That is exactly what the passage explains. Statement number C says that collection account are always illegal. No, this is not in this is the only incorrect statement, because they are not always illegal. They are perfectly legitimate for immigrant and laborer who want to send money home efficiently. Yes, they can be misused for money laundering, but misuse does not make the system itself illegal. That's why C is wrong. And option number D says criminal group may misuse collection account. Exactly. Collection account are legitimate, but criminal group may misuse them to hide the illegal fund. So D is also correct. So question is not correct. So option number C is incorrect, right? I hope it is crystal clear now. So what we learned from this discussion is that, collection account, just remember it. Collection account, legal use plus illegal misuse, right? If it is legal, then you can use it. If it is illegal, misuse, right? So legal concept plus unlawful misuse, reality of collection account. Now have a look at the next one. The next question is, who appoint the director of FIU? That means very good question. That director of FIU is appointed by whom? That is what the question is all about, right? As per the PMLA Act. Option they have mentioned: RBI, Appointment Committee of the Cabinet, Central Government, Ministry of Home Affairs. So what does the law say? First of all, let's look at what does the law say. There is a section number 49, subsection number 1 of the PMLA 2002, and this clearly says that the central government has the legal authority to appoint. Central government has the legal authority to appoint FIU-IND. So the power directly lies with the central government. So if we look at the option A say Reserve Bank of India. So they have no role in appointing FIU-IND. Option B say ACC acting independently. So ACC. So ACC appoint the senior appointment, but the legal power to appoint still lie with the central government. This is also incorrect. Option C says that the central government. Exactly, this is the correct one. And option D say Ministry of Home Affairs. No. Actually, FIU-IND does not fall under MHA. It fall under Ministry of Finance or Department of Revenue, right? So FIU director means finance plus government direct power, right? Please remember it. Now, one question is, which of the following statement correctly describe the role of Riggs Bank in the Augusto Pinochet money laundering scandal? This question was asked in the recently held examination. Options they have given: that Riggs Bank reported Pinochet suspicious account to US regulator leading to legal action. B says that Riggs Bank helped Augusto Pinochet hide and move millions of dollars by concealing his account from US federal regulator. C says that Riggs account froze all the account linked to Pinochet as soon as allegations surfaced. D says that Riggs Bank refused to deal with Pinochet due to a strict anti-money laundering control. So which option correctly described? That's what the question is. Let's understand the real story behind it, right? Let's understand the real story behind this scandal in the simplest term possible. What is this Pinochet account all about? This scandal is all about. Let's understand. Basically what happened, there was a bank. The bank name was, Riggs Bank, right? So basically Riggs Bank, this was a respected US bank at that time. They plays a negative role. They plays a negative role in helping dictator. Dictator name was Augusto Pinochet, right? So they secretly move money. So this bank helped this Augusto Pinochet secretly move money. So instead of following the AML rule, the bank opened hidden account. The bank opened hidden account for Pinochet, right? Concealed his identity. The bank concealed his identity. And then what happened? Did not report in suspicious transaction. Suspicious transaction was not reported. Helped the Pinochet keep access to millions of dollars. Helped millions of dollars, right? Allegedly stolen from people of child. So this incident was in the country of child, right? So this was direct violation of the US anti-money laundering law. So let's look at the option. Option number A says that Riggs Bank reported Pinochet. No. Actually, Riggs Bank did not report the suspicious activity. In fact, they hide his account from regulator. Option B is the perfect one, right? Riggs Bank helped Augusto Pinochet hide and move millions of dollars. Exactly. C says that Rick's bank froze all account. No. That's completely wrong. And option D says that Rick's bank refused to deal with Pinochet. No, that's wrong. Right. So option number B is the correct one. So you can remember it like this. There is a mnemonic you can use. Just remember it. Rigg's rigged it. Rigg's rigged it. Which means they remind you that Rick's bank did not follow AML rule. That is anti-money laundering rule.
It documents or equivalent e-documents to be obtained by the reporting entity. Option A, registration certificate of the trust. So remember, which of the following is not? This is the keyword. Right, let me highlight it. So option A, registration certificate for the trust. Option B, trust deed. Option C, PAN or Form 60. And option D, memorandum or accession of trust. So let's look at each and every option. First of all, option A. What about the registration certificate of the trust? Do you think that it is required? What do you think about it? Yes, this is required. It is required. Why? Because this certificate proves that trust is legally registered. Because this particular certificate proves that trust is legally registered. That's right. Yes, registration certificate of the trust is required. Yes, because this proves that trust is legally registered. Without it, the bank cannot confirm the legal existence of the trust. What about the trust deed? Yes, I think trust deed is also mandatory. Just like an individual, a trust also needs a tax identity, right? So that is the point. So basically, trust deed is like the constitution of the trust. So you can think of the constitution of the trust. It explains why the trust was formed, right? What power, who the trustee are, what power they have. Bank need this to know how the trust will operate. The third is PAN and Form 60 of the trust. Yes, this is also required, right? Just like individual, a trust also need a tax identity. So either a PAN card or Form 60, if PAN is not available, it must be submitted. What about option D? A memorandum of and accession of trust. This is not required, right? So remember, MOA and AOA, these things are not required to the context of trust. Because memorandum of association or MOA is for companies and societies. So they are mandatory for, companies. They are mandatory for societies, right? Not for trust. That's why it is not required for opening a trust. So the correct answer is option number D. Yes, this is the correct answer. So what we have learned, for trust account, bank need registration certificate, trust deed, PAN and Form 60 and detail of the trustee. MOA is for company, not for trust. So that is the point. Now friends, let's look at the next question. The next question that we have is related to the designated director. Very important one. Let's understand it. So we are going to crack an important MCQs under the designated director. So which of the following statement correctly describe the role and eligibility of a designated director under PMLA, PMLR and the regulatory guidelines? Option A. A designated director must always be the chairman of the company regardless of the structure and is only responsible for ensuring the audit compliance. Option B. A designated director may be the MD, may be MP, may be managing trustee or a senior management individual and is responsible for overall compliance including the KYC system. Option C. Designated director is a junior compliance officer who files suspicious transaction report and does not need to be formally authorized by the board. And option D. Any employee of the bank can be nominated as a designated director provided they have the knowledge of the customer service and branch operation. What do you think? Let's go through each and every option. First of all, let's start with option number A. What do you think about option number A? So option number A says that DD must always be the chairman. This is wrong. DD is not always the chairman. It depends on the types of organization, right? And it says that it ensures, option A says that he must be chairman. No, DD rule is much wider than just audit. It's all about full compliance with PMLA, KYC, AML system. Let's look at option number B. Option number B is correct. Yes, this is the correct one. Why it is correct? Because managing director in a company, right? Managing director in a company, managing partner in a partnership firm, proprietor in a proprietorship, and managing trustee in a trust, right? Or senior management individual in cooperative bank and RRB. So, and the responsibilities, they ensure compliance with the law, right? They ensure overall compliance. They ensure updating KYC, staff training, take measures against money laundering, and terror financing risk. What about option C? Option C says that DD is a junior compliance officer filing STR. That is not true. That is wrong. Because filing STR is usually the job of PO. Remember, suspicious transaction report is to be filed by the PO. Who is PO? PO is called the principal officer, not the designated director job. So DD has a higher role, right? DD has to ensure the accountability at the top, right? So filing, this filing has to be done by the PO. PO means, you know what is the meaning of PO? PO means principal officer. Now what about option D? It says any employee. This is wrong again. It has to be someone at the top management level. It says any employee. It is wrong. It has to be someone at the top management level, right? Not just any staff who know the customer service. So what we learned from this discussion is that, that designated director, remember this DD, he is the top level person. He is the top level person who is responsible for PMLA and KYC compliance. And position depends on structure. So you can see position may be MD. You can see MD, MP, right? Proprietor, MT, anything. Responsibility includes KYC system, staff training, policy update, and MLTF measure. And DD is not principal officer. Remember, DD is separate than the principal officer. Those two are separate. DD is not principal officer. DD is accountable at the top. PO is more operational. Now friends, let's look at the next MCQ that we have. So friends, before proceeding to the next MCQ, let me tell you, if you want any kind of study material for the AML KYC in the form of unit-wise theory, which is made from the Macmillan book, or if you want unit-wise MCQs, which consists of 50 MCQs, average 50 MCQs per unit, almost 2000 plus MCQs in the entire syllabus. If you want previous year memory-based question like this, you can enroll in our course of AML KYC, which is available at reasonable rate. For more detail, you can WhatsApp me on this particular number, right? You can WhatsApp me on this particular number for more detail. In the description section of the video, you will also get the course link. Now friends, let's look at the next question. This question pertains to the primary function of FIU-IND. So we will solve a very important MCQs on FIU-IND. Which of the following is the primary function of FIU-IND under the PMLA, right? So question is asking you to find the primary function of FIU-IND under the PMLA. Options are regulating monetary policy and setting benchmark interest rate. Option B, collecting, analyzing, disseminating information on suspicious financial transaction. Option C, issuing banking license and supervising the credit policy of the bank. Option D, managing foreign exchange reserve of the country. Let's go through option by option. First of all, option A. See, this is actually the job of RBI, right? Monetary policy monitoring, job of the RBI. For example, RBI decide repo rate, reverse repo rate to control inflation and liquidity. Second is collecting, analyzing, disseminating information. Yes, this is exactly what FIU-IND does. Imagine a bank notice that a customer deposit 10 lakh rupees. Bank notice that customer has deposited 10 lakh cash every day without any clear source. Customer is depositing 10 lakh cash every day without any clear source. So the bank report it as an STR, that is called suspicious financial transaction report, right? FIU-IND then collect it, analyze the pattern and share the intelligence with the enforcement agency like ED, CBI or income tax department. Option C say issuing banking license and supervising the credit policy of the bank. Again, this is the role of RBI, right? RBI give license to the new bank and decide how much credit flow should be regulated. FIU-IND does not guarantee license. What about the next last part, managing foreign exchange reserve? So this is also the job of RBI, right? Foreign exchange reserve managing is the job of RBI. RBI manages forex reserve to keep the rupee stable. FIU-IND is not involved here. So what we learned from this discussion is that, whenever you see this word FIU-IND, just remember, this is called Financial Intelligence Unit India. It was formed in the year 2004. It worked under the Department of Revenue. Right, Ministry of Finance. And its role is to collect, analyze and disseminate information on suspicious financial transaction. Report it handle like CTR, like STR, right, NTR, CBWTR. Now friends, let's look at the next question. The next question is, as per the section 4 of the PMLA, what is the prescribed punishment for committing the offense of money laundering? So let's see the option that we have. These are the 4 options that we have, right? So basically the first option says simple imprisonment of not less than 1 year, but which may extend to 3 years with fine. Option B say rigorous imprisonment of not less than 3 years, but which may extend to 7 years and also liable to fine. Option C say rigorous imprisonment of not less than 5 years, which may extend to 10 years with fine. And option D say simple imprisonment of not less than 2 years, which may extend to 7 years with no fine. So these are the 4 options that we have. So let's see the answer. Let's see the option by option. Option number A, simple imprisonment of not less than 1 year. See, this is wrong. Option number A is wrong. Why it is wrong? Because This is incorrect because the punishment under PMLA is not simple imprisonment. It is a rigorous imprisonment. So remember, if you do any punishment under PMLA, it is just a rigorous, right? It is rigorous imprisonment. It is not simple imprisonment. Rigorous means tough jail time with hard labor, not just sitting in the prison. Right? What about option B? Option B is a rigorous imprisonment but not less than 3 years, but which may extend to 7 years. Yes, correct. This is the correct one. This matches the section 4 exactly. Minimum punishment 3 years, maximum punishment 7 years, and yes, fine is also applicable. Option C say rigorous imprisonment of 5 to 10 years with fine. This look attractive because sometimes people remember 10 years, right? But that is a special case, only for certain offense like narcotic case under the NDPS Act. So this is only for narcotic case under the NDPS Act. Right. In general case, it is 3 to 7 years. And option D say simple imprisonment of not less than 2 years, which may extend to 7 years with no fine. Again wrong, because the imprisonment is rigorous, not simple, and the fine is definitely applicable under PMLA. So what we have just discussed, let me just summarize. I told you we have talked about the section 4 of the PMLA, right? So this section 4 of the PMLA, it talks about punishment for the offense of money laundering. Normal rule is rigorous punishment, rigorous imprisonment 3 to 7 years plus fine, right? So 3 to 7 year rigorous imprisonment plus also fine is applicable. Okay, for some serious offense like narcotic, some serious offense like narcotic under NDPS, the punishment can go up to 10 years, but the general is 3 to 7 years. In a special case, it can go up to 10 years. Now friends, let's talk about the one question on which of the following correctly explain the social and political effect of the money laundering. Very good question. Basically, option is which of the following correctly explain the social and political effect of the money laundering in a jurisdiction where it is not effectively controlled. Option A, it results only in the loss of government revenue but has no impact on crime or politics. B, it increases corruption and organized crime. It creates safe haven for criminals, affecting the social environment. Option C, it primarily weakens the banking sector but leaves society and governance structure largely unaffected. It strengthens the democracy by bringing illicit fund into the circulation and boosting the political funding. Very good question. Which of the following correctly explain the political effect? So option number A, if you look at the option number A, which says that it only cause revenue loss, nothing else. What do you think about it? This is incorrect. Why? Because the effects are much deeper than the tax revenue. It only talked about the tax revenue, but the effects are much deeper. Right? Money laundering, spread corruption, strengthen criminal, weaken governance. Yes, that is what it does. So that's why option number A is wrong. It just talks about loss in government revenue. No. What about option B? Yes, option B is the correct one. Why option B is the correct one? Because money laundering is when money laundering is unchecked, corruption grow because corrupt officials hide their wealth. Corruption will grow. Right? Why? Because corrupt officials will hide their wealth. Organized crime will increase. Right? And such country becomes safe haven for criminal. They become safe haven for criminal. And the worst part is that over time, these criminals start influencing politics, weakening institutions, and even threatening the democracy. Right? So these are the things. Influence and even undermine the social, political, and democratic system. What about option C? Option C say it mainly weaken bank, but society and politics remain safe. See, this is not correct. Banking weakness is one effect. Right? Banking weakness is one effect. But the bigger danger is corruption. Right? The bigger danger is corruption, social damage, and political influence. What about option D? Option D say it strengthens the democracy by boosting the political funding. See, that is completely wrong. Illicit fund does not strengthen democracy. They undermine it. Illicit fund. Illicit fund, what it does? It basically undermines the democracy. Right? Because dirty money buy power and control. So let's quickly summarize the key point. Yes, we talked about the social effect. See, it has both social effect as well as the political effect. How is the social effect? Yes, social effect is that more corruption, more organized crime. First of all, corruption is a kind of social effect. Second example I can give you is organized crime. Organized crime also happen. And it is a safe haven for criminal. Second is political effect. If you look at the political effect of it, so criminal gain influence. Criminal gain influence. It weaken our institutions. Our institutions become weak and can even erode the democracy. So money laundering is not just a financial crime. It is a threat to society, politics and national security. I hope it is clear. Now the next question that was asked, that as per the given information, how many member does the Egmont group of FIU currently have? This question is most frequently asked. Egmont group is the most frequently asked question. I request you to please learn it wholeheartedly. Egmont group. Right. Options are 101 member, 121 member, 151 member and 181 member. So basically how many members are there? Do you know? The correct answer to this question is 151 member. So the Egmont Group is an international network of financial intelligence unit established to strengthen the cooperation in the fighting money laundering and terrorist financing. Right. So its objective includes bank make up the membership of Wolfsburg Group. And so basically this was the question which was asked in the examination. Options are 10, 13, 15 and 20. Let's understand each option carefully. First of all, option A. Option A say 10 global bank. So this option look close, but it is not correct. The group is slightly bigger, not 10. What is the option B? Option B says 13 global bank. So this is the correct answer. The Wolfsburg Group is made up of 13 leading global banks formed in the year 2000. It was formed in the year 2000. There are 13 global banks, right? They came together to fight the financial crime like money laundering and terror financing. So like money laundering and terror financing. Okay. So 13 leading global bank. What about option C? 15 global bank. Again sound possible, but the number is not 15. Some examiner put nearby number to confuse us. What about option D? It says 20 global bank. See, basically definitely too high. The Wolfsburg Group is exclusive, not such a large membership body. So you can think of the Wolfsburg Group like the Avenger of the banking world. 13 powerful global banks united to protect the financial system from criminal. So let's quickly summarize the key point. What we have discussed, it is an association of the 13 leading global banks. First point, it was formed in the year 2000. It focuses on anti-money laundering and KYC and terror financing, CFT, countering the financing of terrorism. Right. So whenever you see this in exam, remember 13 bank fight financial crime together. Okay. Now let's look at the next one. This question is regarding the UCIC. So friends, today we are discussing a very important question related to UCIC, which is Unique Customer Identification Code. So which of the following correctly explain the provision regarding the UCIC as prescribed for bank and NBFC? Options are UCIC must be allotted only to the new customer opening account in the bank while existing customer are exempted. Option B, it is mandatory for both new and existing customer but not required for walk-in and occasional customer. Right. So for both new and existing customer but not required for walk-in or occasional customer such as purchaser of prepaid instrument. Option C say UCIC is optional for all customer and bank NBFC may decide whether to issue it depending on their internal policy. And option D say that UCIC can only be issued to corporate customer, not individual, since it is linked to business entity identification. So let's understand each option one by one. First of all, option number A. What do you think about option A? This is wrong. Why? Because RBI say UCIC has to be given to both new and the existing customer. What RBI say? That UCIC must be allotted to both the new customer as well as the original customer, existing customer. Okay, as well as the existing customer. Existing customer also need to be covered over the time so that same customer can be uniquely identified across all product and services. So that's why option number A is wrong. What about B? B says that it is mandatory for both new and existing customer. Yes, very good. It is correct one. This is correct because regular customer must always have UCIC. But for one-time customer, which we call walk-in occasional customer, we can also call them one-time customer. Okay. So for one-time customer or walk-in or occasional customer, like someone buying a prepaid card or one-off product, UCIC may not be issued immediately. However, if that customer keeps coming back, then UCIC become mandatory. Imagine someone buys a prepaid gift card once. No UCIC is required. Right? Someone who is buying a prepaid gift card once, in that case no UCIC. But if that same person keep coming every week to buy multiple products, the bank will assign them a UCIC to track transaction properly. Okay, so that is the point. Now, what about option C? Option C says UCIC is optional for all customer and bank NBFC. No, this is completely wrong. Because UCIC is mandatory as per RBI. What about option D? It can only be issued to corporate customer, not individual. Again, it is wrong. UCIC is for all type of customer, individual, corporate. The whole idea is to uniquely tag every customer in the system. So remember what we have discussed just now. Remember the full form. Unique customer identification code. It is mandatory for all the regular customer and not required for walk-in or occasional customer. Purpose is better customer data management, risk profiling and monitoring suspicious data. Now one question which was asked based on UAPA. Let's have a look. So the question is, which of the following correctly describe the key feature of the Unlawful Activities Act or UAPA as amended? So these are the options that we have. So option number A says that UAPA enacted in 1967 focuses only on unlawful political association and has no provision relating to terrorism or financing of terrorism. Option B say UAPA amended in 2008 incorporated measures to combat financing of terrorism in line with UN Security Council resolution. Option C say UAPA amended in 2013 was diluted to reduce its scope and exclude property seizure connected with terrorist organization. Option D say UAPA only applied domestically and has no connection to international obligation such as FATF standards. So what do you think is, which of the option do you think is correct? So option number A. Option number A says that UAPA was only about political association and nothing to do with terrorism. What do you think about it? This is wrong. Option A is wrong. Why? Basically UAPA started in 1967. This is correct. Yes, it was enacted in the year 1967. This is correct. Right. Basically it was enacted mainly to deal with unlawful political association. The full form itself say unlawful. What is the full form? Right. Unlawful Activities Act. So it was enacted in 1967 to deal with unlawful political association, but later it was expanded. After the 2008 amendment, terrorism and terrorist financing become a major part of the act. So two things, right? Let me write it down. So two things become the major part. The first thing is, terrorism, right? Terrorism. And the second point is terror financing. These two become the part and parcel of the act. So that's why option number A is wrong. It focuses only on the unlawful political action. This is wrong. It has to do with terrorism also. What about option B? It says that it was amended in 2008, incorporated measure to combat financing of terrorism. Yes, this is the correct one. Right. So this is absolutely correct. If someone raises fund in India to support a terrorist group abroad, right. Also, if a property like house or land is linked to terrorism, the government can freeze or seize it. What about option C? It says that 2013 amendment diluted the law and reduced its scope. See, this is completely wrong. This is wrong. Why? Because the 2013 amendment actually made the act stronger. The amendment which happened in 2013, it made the act stronger. Right. It made the act stronger, bringing in line with FATF standard. It bring in line with the FATF standard. FATF, Financial Action Task Force, to fight money laundering and terrorist financing. It was not diluted. It was tightened. Right. It is saying that it was diluted to reduce its scope. No. It was not diluted. Rather, it become more tight. What about option D? It says that UAPA apply only inside India and has no international link. This is completely wrong. Why? Because UAPA amendment were specifically made to align with the international obligation. International obligation like, UN Security Council resolution. UN Security Council resolution and, FATF recommendation. So let's quickly summarize the key point. What I have told you, that UAPA is a law to curb unlawful activities and terrorism. Right, remember, it is a law to curb unlawful activities and terrorism. 1967, it was originally an original act, right? And 2008 amendment was there, which included terrorism and terror financing in line with the UN resolution. 2013, it was amended, right? When it was amended in the year 2013. 2013, it was amended, right? Which further strengthened the law to meet the FATF standard, right? I hope it is clear. Now let's see the last question of today's session. The last question is, as per KYC norm, what is the time limit for submission of an officially valid document by low risk customer who are unable to provide it immediately but need to open a bank account without interrupting business? Right, this is the question. Option A, it must be submitted within 3 months from the commencing the relationship. It must be submitted within 6 months from commencing the relationship. It is not required at all for low risk customer once the relationship is established. And D say, it can be delayed indefinitely subject to the bank approval. So, which option do you think is correct? So let's look at option number A. It says within 3 months. What do you think about 3 months? No, this is incorrect. It looked tempting because 3 months is a common timeline in some compliance area. But the rule is not 3 months. What about 6 months? The rule is that if the customer is of low risk, right? Like a salaried person opening a saving account, or someone with a small bank balance account. So the bank can open the account immediately, right? But the customer must submit their OVD within the 6-month timeline. For example, take the case of Ramesh. Let's understand with one example. Take the case of Ramesh. Now Ramesh, right, is a salaried employee. He want to open a bank account, but he has misplaced his Aadhaar card. So the bank can open his account today, but Ramesh must give Aadhaar card or another OVD within 6 months. So remember the 6-month timeline is there. So let me highlight the keyword 6 months. Right. What about not required at all? Option number C, this is wrong. Option number C is wrong because it says not required at all. C, KYC is mandatory for all customer. Even low risk customer must eventually provide OVD. What about D? It can be delayed indefinitely. There is no such thing like indefinite relaxation. The maximum time limit is 6 months. And after that, if documents are still not provided, the bank must freeze or restrict operation. So what we have discussed just now, let me summarize. I told you that bank can open account immediately for low risk customer even without OVD. But OVD must be submitted within 6 months. After 6 months, if OVD is not given, the bank must take regulatory action. Correct answer is option B. Friends, we have more questions available with us. And that is memory based. If you want me to bring the part 2 lecture of this video, please write yes in the chat box. I will provide you the part 2 video. And if you really think that this video was
that which of the following statement about the Egmont Group of Financial Intelligence Unit is correct, right? So option A say it is a formal organization established by the United Nations to regulate the banking system. Option B, it is an informal network of FIU aimed at promoting cooperation in information exchange, training and sharing of expertise. Option C, membership in the Egmont Group is optional for FIU under the FATF 2012 standards. Option D, it has published only the Egmont Charter and nothing else and currently has 100 members. Very good question it is. So let's see option wise. First of all, option A. Why this is wrong? Because the Egmont Group is not a UN body. It says United Nations body. No, it's not a UN body. First of all, it is not an informal organization. Rather, it is an informal organization, not a formal. It does not control bank, right? It said to regulate banking system. No, the Egmont Group does not control bank. Rather, it helps financial intelligence unit share information to catch criminal. You can think of it like a WhatsApp group of detective from different countries. They share tips but don't make laws. Now let's look at option number B. Option B say it is an informal network of FIU aimed at promoting cooperation in information exchange, training and sharing of expertise. Why this is correct? Because exactly right. The Egmont Group is like a global club of FIU. Their job is to help each other share information, train and fight financial crime like money laundering. Imagine police from different countries meeting to swap crime fighting tricks. That is the Egmont Group. What about option C? So option C is wrong. Why? Because FATF, that is called Financial Action Task Force, says FIU must join in the Egmont Group. It's not optional. It is a must do to fight money laundering properly. Like how a school requires student to attend class. Similarly, FIU must join Egmont to stay compliant. What about option D? So option D is also wrong because they have published more than just the charter. It says they have published only the Egmont Charter. No, they have published more than the Egmont Charter, like guidelines on the information sharing. They now have 151 members, not 100. That's why option number D is incorrect. Saying they only have one document is like saying YouTube has only one rule. No, there is a way more. So what we learned from this question is that that this Egmont Group is an informal network, not a UN body or not a bank regulator. Their main job is to help financial intelligence units share information, train and fight the financial crime. And the third point I told you that their membership is mandatory as FATF says so. And they are more than just the charter. They have multiple documents and they have 151 members. So the correct answer is option B. If it helps, smash the like button, share with friend and drop a comment. Right. Now friends, let's see the next question. Friends, if you are looking for a study material for AML KYC, then you can WhatsApp me on this particular number. So we have a study material in which we provide you PDF. In PDF includes unit-wise theory, unit-wise MCQs and previous year question. Many aspirants of AML KYC have cracked the exam previously using our material. So you can also join their league. For more detail, you can WhatsApp me on this particular number. Now, let's see the next question that we have. So the question number 2, which were asked in the examination was like this, So we are breaking question is which of the following statement about Wolfsburg Group is correct? Option A, it is an association of 13 global banks formed in 2000 to develop framework and guidance for managing financial crime risk, especially in relation to KYC, AML, and CFT policy. Option B. It was created by the United Nations to regulate financial institutions worldwide and enforce AML law. Option C. Its primary purpose at inception was to prepare AML guideline for public sector bank. Option D. It only focus on CFT measure and does not issue guidance on KYC or AML. Very good question. This question is regarding the Wolfsburg Committee. So option number A is correct because this Wolfsburg group, it is a club of 13 big banks like HSBC, like Citibank, etc. It was started in the year 2000 to fight financial crime. Their main job was to create rule and best practices for KYC, which means know your customer, checking who client really are. AML, which means anti-money laundering, which means stopping the dirty money, and then CFT, which means counter-terrorism financing, which means the blocking the terror fund. You can think of it like a group of top chefs making food safety rule, but for bank instead of restaurant. Option B says that it was created by United Nations to regulate financial institutions. This is wrong. This is not a UN group. It is a private formed by the bank themselves. Right? It is a private group. They are formed by the bank themselves. UN has nothing to do with that. And second point is that does not enforce law. See, it only give guidance. It does not enforce any law. It is simple example. It's like a car club making safe driving tips, not the traffic police handling out tickets. Option C. Its primary purpose at inception was to prepare AML guideline. This is wrong because it started for private banking, wealthy clients, not government banks. Right? It is saying for public sector banking. This is wrong. It was started, for wealthy clients for private banking, not the government banks. Later it was expanded to cover all banking. Like a luxury watch brand, first making rule for gold watches, then later for all watches. What about option D? It only focus on CFT measure and does not issue guidance on KYC or AML. So why this is wrong? Because it cover all the three, KYC plus AML plus CFT, not just terrorism financing. Simple example I can give you. Saying it only does CFT is like saying Netflix only has action movie. No, it has everything. So friends, what we learned from this particular question is that Wolfsburg group is a 13 big bank teaming up since the year 2000. Their main job is to fight financial crime with KYC, AML, CFT guidelines, and they are started for the private banking. Now cover all. They are not, not a UN regulator, just a best practice advisor. They are not UN regulator, rather they advise the best practices. Now, then the next question that we have is very good question regarding the CCO, Chief Compliance Officer. So the question is, which of the following is not a duty or responsibility of the Chief Compliance Officer as head of the compliance function? So not a duty. Remember, the keyword is not. Option A say, apprising the board and the senior management on regulation, rules, standards and development. So option B say, conducting an annual compliance risk assessment and preparing a risk-oriented activity plan for the approval by the ECB Audit Committee Board. Option C. Monitoring and periodically testing compliance and placing results before the board. Option D. Approving and introducing new financial product without consulting other department. Option E. Ensuring time-bound and sustainable compliance with RBI supervisory observation and other official direction. So let's see the option number A first. So is this a real duty? Yes. What does this mean? The CCO is like a news reporter for rules. They update the board, they update the CEO on the new laws and the risk. For example, if RBI changes a rule, the CCO must inform the top management. So you can think of them like, a weather forecaster, warning the company about regulatory storm ahead. What about option B? It says conducting annual compliance risk assessment and preparing a risk-oriented activity plan for approval by the ECB. Is this a real duty? Yes. It means that CCO does a yearly health check on compliance risk. They make a plan to fix gap and send it to audit committee. For example, like a car mechanic doing an annual inspection and suggesting the repair. What about option C? Monitoring and periodically testing compliance and placing result before the board, ECB, MD and CEO. Is this a real duty? Yes. The CCO check if the rule are being followed or not. They report finding to the big boss like board, like the CEO, like a school inspector checking if the teacher follow the curriculum or not. What about option D? Approving and introducing new financial product without consulting other department. So is this a real duty? No. Why this is wrong? Because the CCO does not launch product alone. That's the sales or risk team job. Their role is oversight, not business decision. You can imagine a referee in a football. Their job is to enforce the rule, not to score the goal. What about option E? Ensuring time-bound and sustainable compliance. Yes. Is this a real duty? Yes. What does this mean? Because if RBI say fix this, so the CCO makes sure that it gets done properly and on time, like a project manager ensuring deadlines are met. So what we learned from this question is that CCO acts like a rule enforcer, not a product creator. Their main duties is to report new regulation, that is our option A, is to yearly risk check, that is the option number B, is to monitor compliance, that is the option number C, is to ensure that RBI orders are followed, that is option number E. But what is not their job? Launching product alone, that is not their job. So the correct answer is D. The CCO does not approve products solo, rather they are the company's rule guardian, right? I hope this helped you understand the basic concept regarding the function of CCO. If it really does, please hit that like button and share with other aspirants who are preparing for the AML KYC examination. Friends, I have prepared one more set of questions. If you have not watched that video, please check out the description section of this video. I have provided the link of the same. And also we have a Telegram group in which we post quizzes, in which we post memory based questions, topics, and every information related to the examination. You can join that. It's completely free of cost. Now friends, let's talk about the next question. So the question is, which statement accurately represent the United Nations Vienna Convention against illicit traffic in narcotic drugs 1988? Very good question. Accurately represent. Which one is correct is being asked. Option A, it mandates the UN Office on Drugs and Crime to establish program for countries to prevent drug trafficking. Option B, it requires law criminalizing the conversion or transfer of property derived from drug trafficking and related offense. Option C, it provides for mutual legal assistance, transfer of proceeding, international cooperation among nations. Option D, it was the first step to establish a legal regime for the prevention of money laundering. So let's see the option. Option number A suggests that it mandates the UN Office on Drug and Crime, that is called UNODC, to establish program for country to prevent drug trafficking. Is it true? Yes. What does this mean? That UNODC was tasked to create anti-drug program for the nation. For example, training police to track drug cartels. Like a global coach helping country fight drug crime. Similarly, this also. What about option B? Option B says it requires law criminalizing the conversion or transfer of property derived from drug trafficking. Is this true? Yes, it is true. What does this mean? That means country must ban laundering drug money, that is turning cash into fake business. For example, a law making it illegal to hide drug profit in the real estate. Simple analogy, like making it illegal to wash dirty cloth, but for money. What about option C? It provides for mutual legal assistance, transfer of proceeding, international cooperation. Is it true? So what we are discussing on, we are talking about the UN Vienna Convention against illicit traffic in narcotic drugs. Is it true? What about option C? Yes, it is true. It means that country must help each other catch drug lords, like extradition, sharing evidence. For example, the US and Mexico collaborating to arrest a cartel leader. Then we have option number D. It was the first step to establish a legal regime for preventing money laundering. So we are talking in the context of UN Vienna Convention. Yes, it is true. This was the first global treaty targeting drug-linked money laundering. Later, FATF expanded this rule to all the crimes. Right. So all of them are correct. So option number E is the correct one. So what we'll come to know that the first option. What is the key takeaway? UNODC. Remember the full form. United Nations Office on Drug and Crime. So this program help country fight drug trafficking. Option A. Option B, criminalizing dirty money. So ban hiding drug profit. Option C, global teamwork. It forces cross-border cooperation. Pioneering the anti-laundering, which means first treaty that targeted the drug money. And all are correct. So these are all the points related to the UN Vienna Conventions. I hope it makes sense to you. Now friends, have a look at the next one. Very good question it is, and this question is most frequently asked. So question is, which of the following statement? So the question is, which of the following statement about the Unlawful Activities Prevention Act 1967, in short we call it UAPA, is correct, right? Option A, that UAPA was amended in the year 2008 to include legislative measure for combating financing of terrorism consistent with the UN Security Council resolution, right? Then the act criminalized terrorist act and raising of fund for terrorist act. Option C. It provides for attachment and seizure of property connected with the terrorist activity or organization. Option D. The 2013 amendment enhanced the act to strengthen prevention of unlawful activities and to meet the FATF standard. Option E. All of the above. So have a look at this particular question. So let's see the option number A. The UAPA was amended in 2008 to include legislative measure for combating financing of terrorism. What does this mean? It says that in 2008, India updated the UAPA to stop terror funding as per the UN rule. What is UAPA? Unlawful Activities Prevention Act. Yes, India amended it, right? For example, if a group fund terror activity, the law cannot punish them, like updating your phone antivirus to block the new threat. So what about option number B? Option number B says, that the act criminalizes terrorist act and raising of fund for terrorist war. Yes, this is correct. It means UAPA bans terrorism and collecting money for terror. For example, if someone fund a bomb attack, they can be jailed under UAPA. Like making both robbery and hiring robber illegal. What about option C? It provides for attachment and seizure of property connected with terrorist activity or organization. Is this correct? Yes, it is correct. It means that police can freeze properties linked to the terror group. For example, if a terror group owns a house, the government can seize it, like confiscating a thief's stolen car. What about option D? It says the 2013 amendment enhanced the act to strengthen prevention of unlawful activity and to meet FATF standard. Is it correct? Yes, it is correct. It means, in 2013, India make UAPA stronger to stop terror funding as per FATF rule. For example, bank now reports suspicious transaction linked to terror, like adding new security camera in a high crime area. So the correct answer to this question is all of the above, right? So A, B, C, D all are true. So answer is E. So what is the key takeaway from this question is that 2008. So we are talking in the context of UAPA. What is UAPA? Unlawful Activity Prevention Act 1967. In the year 2008, there was an update. Just I'm taking you the key takeaway, right? I'm summarizing the fact. In the year 2008, UAPA added anti-terror funding rule, which is backed by UN. It bans terrors, it bans funding, it punishes both act and money raising. Property seizure, I told you, government can freeze terror-linked asset. 2013, it was again updated, made law stronger to meet the global standards. 2013 amendment enhanced the law to strengthen, to meet the global standard that is called FATF standard. So the correct answer is all of the above. Right, so UAPA is a very, very powerful law against the terrorism. If it helps, do smash the like button. Now friends, have a look at the next one. So this question is regarding the CCR. Yes, very good question it is. So the question is, which statement about counterfeit currency report, or we call it CCR, is incorrect. Right, option A, CCR cover all cash transaction where counterfeit currency notes have been used. Option B, CCR also covered transaction involving forgery of valuable risk security or a document that facilitates the transaction. Option C, the report is required to be submitted monthly by the 15th of the next month. Option D, CCR must be filled immediately on the same day the counterfeit note is detected. So these are the options, and question is asking you to find the incorrect one. So let's see the option A. Option A says CCR cover all cash transaction where counterfeit currency notes have been used. Is this true? Yes, it is true. What does this mean? It means that if fake cash is used, even rupees 100 rupees note, bank must report it via CCR. For example, suppose a shop deposit 10,000 rupees, but 2,000 rupees is counterfeit. So CCR has to be filed. Like a fake ticket at a concert, security must be alerted. What about option B? So if you look at the option B, it says that CCR also covered transaction involving forgery of valuable security or a document that facilitate the transaction. Is it true? Yes, it is true. What does this mean? It means that beyond fake cash, CCR include forged check, bond, fake ID, which is used in the transaction. So beyond fake cash, CCR include forged check, bonds or fake ID. For example, someone deposited a fake fixed deposit receipt. So CCR has to be filed. For example, I will give you an example like reporting both fake money and fake passport at the airport. What about option C? The report is required to be submitted monthly by the 15th of the next month. Is this true? Yes, it is true. This means that bank don't report daily. They compile cases and submit by the 15th of next month. For example, July fake note are reported by the August 15, like submitting a monthly school attendance report, not every day. What about option D? CCR must be filed immediately on the same day the counterfeit note is detected. Is this true? No, this is incorrect. Because CCR is not a same day, it is a monthly by the 15th. Only urgent report like terror funding needs immediate filing, not CCR. Imagine reporting exam cheating monthly. versus calling police right now for a fight. So what is the key takeaway from this question is that, so option number D is the correct one, right? This is incorrect. So what we learned that CCR cover fake cash and CCR cover the fake document. Option number A is about fake cash, option number B is about the fake document. Reporting timeline for CCR is monthly by 15th, not same day. So option number C is regarding monthly by 15th and same day, that is option number D is incorrect, right? So the incorrect statement is D. CCR is monthly, not the instant. Remember the full form, counterfeit currency report, right? Now have a look at the next question. This question is regarding which of the following statement about the USA Patriot Act. You know, in your book there are some act which has been given and they are the super important. Question are asked every year, every examination regarding these acts. So you must make sure to go through these acts. Question is which of the following statement about USA Patriot Act of 2001 is correct? Options are: it criminalized the financing of terrorism and strengthened customer identification procedure. Option B: it prohibit dealing with foreign cell bank and require enhanced due diligence for correspondent and private banking account. Option C: it improves information sharing between financial institution and the US government, including voluntary sharing among institution. Option D: it imposes special measure on jurisdiction or transaction deemed primary money laundering concern and uses a bank AML record as a criteria for merger and acquisition. Very good question it is, right? So option A, let's start with option A. It criminalized the financing of terrorism and strengthening customer identification procedure. We are talking in the context of USA Patriot Act. Yes, it is correct. The act made it illegal to fund terrorism, like giving money to terror group. Bank now verify customer more strictly, like making it illegal to pay a hitman and requiring ID check at the bank. Option B, it prohibit dealing with foreign cell bank and require enhanced due diligence for correspondent and private banking account. Is this correct? Yes, it is. What does this mean? Cell bank are the fake bank with no real office. They are banned. Bank must double check high risk account, like foreign client account. For example, like banning fake company and doing extra background check on suspicious client. Option C say it improve information sharing between financial institution and the US government, including voluntary sharing among. CFATF is an organization of 27 Caribbean basin state established in the year 1992. Option B, in May 1990, a representative from the Caribbean and Central America identified 19 region-specific issues which were adopted in the November 1992. Option C says CFATF issues public statement reviewing the jurisdiction based on measures taken to address deficiency found in mutual evaluation. Option D says CFATF primarily work on drug trafficking prevention and does not focus on financial crime. Option E say A, B and C are correct. So let's see which option is correct regarding it. So let's see the option number A. Option number A is that it is an organization of 27 Caribbean basin state established in 1992. Is it correct? Yes, it is correct. What does this mean? It means CFATF is a group of 27 Caribbean or Central American country working together. It was founded in the year 1992 to fight money laundering and terror financing, like a neighborhood watch group but for financial crime in the Caribbean. What about option B? Option B says in May 1990 representative identified 19 region specific issue adopted in November 1992. Is this correct? Yes, it is correct. What does this mean? Because it means that in the year 1990, Caribbean leaders listed 19 unique problems like cash heavy economy, tax haven. By 1992, these become official rule for the CFATF, like a team brainstorming solution before launching a product. What about option C? Option C says the CFATF issues public statement reviewing jurisdiction based on measures taken to address deficiency. Is this correct? Yes, this is correct. Why? Because it means CFATF grade country on anti-money laundering effort. If a country fails, they are publicly named and given time to improve. For example, like a report card for country, pass or fail with consequences. What about option D? The CFATF primarily work on drug trafficking prevention and does not focus on financial crime. Is this correct? No, this is the wrong option. Why this is incorrect? Because CFATF does not just focus on drug, it tackles all financial crime, money laundering, terror funding, etc. And it follows the FATF standards, global anti-money laundering rules. Like saying CFATF only fight drug is like saying a firefighter only put out kitchen fire. No, they handle all kinds of fire. Option E, A, B and C are correct. So yes, this is the correct answer. Since A, B and C all are true, D is false. So E is the right answer. So what we let's summarize what we get to know from this particular question. I told you that CFATF is a combination of 27 Caribbean nations fighting the financial crime. That is option A. It was founded in the year 1992 based on 19 regional issues. Option number 2. Option C says publicly rate country. Yes, it publicly rate countries on anti-money laundering progress. That is option C. Option D, not just drug. It cover all types of financial crime. Right. So the correct answer is option number E. A, B and C are all correct. Now friends, the question is which of the following statement about sale companies and sale bank is incorrect. Option A sale company generally conduct no real business operation and may exist only on paper. Option B, sale company can be used to create an appearance of legitimate transaction through false invoice and fake financial statement. Option C, sale bank are bank without real banking activity and can be used to launder money. Option D, sale company can only be used during the layering stage of the money laundering and have no role in the placement or integration stage. So which one is incorrect is being asked. So let's go through each and every option. So what about option A? A sale company generally conduct no real business operation and may exist only on paper. Is this correct? Yes, it is correct. What does this mean? So sale company are fake businesses, no office, no product, just paperwork. For example, a company with a fancy name but zero employee or zero sales, like a movie set. It look real but it just facade. Then option B, sale companies can be used to create an appearance of legitimate transaction through false invoice and fake financial statement. Is this correct? Yes, it is correct. What does this mean? It means company use them to fake transaction. For example, a drug cartel sell imaginary goods to justify dirty money, like a fake receipt to claim you bought a laptop you never owned. What about option C? Sale bank are bank without real banking activity and can be used to launder money. Is this correct? Yes, it is correct. What does this mean? It means that sale bank don't take deposit, don't give loan, they just move dirty money. For example, a bank in a tax haven with no customer, no ATM, like a fake delivery service that does not deliver anything, just hide the package. So what about option D? Sale company can only be used during the layering stage of the money laundering and have no role in the placement or integration stage. Is it correct? No, this is the incorrect option. Why this is wrong? Because sale company work in all the three stages of money laundering. The first stage is called placement, where they deposit dirty cash into the fake business account. Second stage is the layering, where they move money through fake transaction. Third step is the integration, where they invest clean money in the real estate or stock. Like saying a Swiss Army knife only open bottle. No, it does way more. So option E, these entities may conceal the beneficial owner and are often located offshore, where access to record is difficult for law enforcement. Is this correct? Yes, it is correct. What does this mean? It means sale company or bank hide the real owner. For example, a criminal owned a Panama sale company but no one can prove it. Like a masked robber, you see the crime but not who did it. So what we learned from this discussion is that sale company, they are the fake business, not real operation. First point, that is option A. It is used for fake transaction, that is called false invoice. Option number B, sale company means fake bank, no real banking, that is option number C. They work in all money laundering stage, not just layering, that is option number D. And they hide honor and plus offshore secrecy. So final answer is option D is incorrect, because incorrect is being asked. Now friends, let's see the last question of today's session. The last question is, which of the following, I think this we have discussed. Yes, let's see the next one. Yes, which of the following statement about the responsibilities of the principal office under the rule 7.2 of the PML rule is incorrect? Option A, the principal officer is responsible for submitting prescribed report to FIU-IND within the specified timeline. Option B, RBI expects the principal officer to be the nodal point in the bank for ensuring regulatory guidelines are operationalized. Option C, the principal officer must formulate and update the bank KYC policy and coordinate with the business unit to ensure KYC AML process are documented in manual, product risk assessment and SOP. Option D, the principal officer has no role in customer risk categorization or adopting due diligence measure in the bank business line. So tell me which one is correct. First of all, let's see option number A. So option number A says principal officer is responsible for submitting prescribed report to FIU-IND. Yes, it is correct. The principal officer must file report like STR, CTR on time to FIU-IND. So you must remember the timeline. Question is asked on the timeline. Like what is the timeline for reporting FI, CTR, STR, etc. So for example, if a suspicious transaction happen, it must report within the 7 days. What about option B? RBI expect the principal officer to be the nodal point in the bank for ensuring regulatory guidelines are operationalized. Is it correct? Yes. What does this mean? So they are the go-to person for RBI KYC AML rule. They must ensure every deployment follow the rules, like a team captain making sure everyone play by the rule. What about option C? The principal officer must formulate and update the bank KYC policy and coordinate with the business unit to ensure KYC AML process are documented. Is this correct? Yes. It means they create, they update KYC policy. They ensure that manual, risk assessment, SOP are in place, like a chef writing recipe so that all cooks follow the same steps. What about option D? The principal officer has no role in customer risk categorization.
Right. So the question is, how do we spot the use of money mules in account? Before we get into the option, let's break it down. You know what is a money mule? Do you know what is a money mule? See, this money mules means what? Is like a middleman used by fraudster to transfer a stolen money. So basically money mule is like a middleman. So money mule is like a middleman used by fraudster, right? It is used by fraudster to transfer a stolen money. What is the main motive? To transfer a stolen money, right? This is the main motive, to transfer the stolen money. So money mules is like a middleman used by fraudster to transfer the stolen money. So these accounts often show certain red flag. So option A says that transactions are always done through the third party. Yes, this is the clear indicator. Fraudster usually avoid direct transfer and use third party to hide their track. Remember, third party transactions are always suspicious, right? Third party transactions are always suspicious. Option 2 says that customer or beneficiary is readily available for contact and provide complete transaction detail. So this does not sound like a red flag, does it? Correct. If someone is cooperative and transparent, they are unlikely to be involved in fraudulent activity. So this is not an indicator of money mule. Option C say customer or behavior is unwilling to meet or uncomfortable providing transaction related information. So absolutely an indicator. Why would someone hesitate to talk about their own transaction unless something fishy is going on? It is a big red flag, right? So another valid sign, imagine a student account suddenly showing massive business transaction. It does not add up, right? So it is a fraud alert. Now option D says transactions are inconsistent with the customer profile or business activity. So transactions are inconsistent with the business profile and customer profile or business activity. So friends, what do you think? Option D, transactions are inconsistent. This is another valid sign, because imagine a student account suddenly show a massive business transaction. It does not add up. So here is your takeaway. So what is the correct answer? Correct answer is option B, right, which is not indicator. A, C, D are indicator. So fraudster often rely on secrecy, inconsistency and third party transaction. Let me write it down. The first thing is that fraudster rely on secrecy. Second thing, they rely on inconsistency, right? Inconsistency. And the third thing, they rely on third party transaction, right? Third party transaction. So why they rely on this thing? To use money mules. The main motive is to use money mules, right? So but if a customer is straightforward and cooperative, like in option B you can see, right, then they are not money mule. Okay, I hope this help you understand your concept regarding the money mule. Now let's move on to the next question. Friend, if you want study material for AML KYC, you can just in the description section I have provided a Telegram channel link. The Telegram group link is provided in the description section. Please join the Telegram link. In that Telegram link you will find previous year question. There are almost 500 students who have already given examination or who are preparing for the exam. You can see what they are preparing, what are the questions being asked in the examination. So I request you to please join the Telegram channel in the description section. Link is provided in the description section. Now let's see the question number 2, which is basically on periodic updation. So the question is regarding, as you can see, so the question is bank classify customer into 3 categories. You know it very well, right? So for first of all, question is how often bank is need to update customer detail based on their risk category, right? Trust me, after this you will never forget this number, right? Let's get started. Question is that how often the bank periodically update customer detail based on their risk category. So bank classify customer into 3 categories: high risk, medium risk and low risk, based on how risky their transaction are. Depending on the category, bank must regularly update their record. Let's look at the time frame for each. Now first of all, let's talk about the high risk customer. First of all, let me tell you the fact.
So if we talk about the high risk customer, these are the one bank keep a close eye on because their transaction could be tricky or prone to fraud, right? Their transaction could be tricky or their transaction could be prone to fraud, right? So for them, bank update their information every 2 years, right? Bank update their information every 2 years, right? Simple to remember, high risk is equal to 2 years. Now next we have medium risk customer. Next, we have medium risk customer. So these folk don't pose as much risk but still need monitoring. For them the updation happen every 8 years. For them the updation happen every 8 years. Think of this as a mid-level check in our safety. And finally we have low risk customer. For low risk customer, these are your super safe customer, like someone with a simple saving account and no unusual activity. For them, bank update detail every 10 years. For them, bank update detail every 10 years, right? So low risk is equal to long time is equal to 10 years. So here is a quick recap: high risk every 2 years, medium risk every 8 years, and low risk every 10 years. So it is easy to remember once you break it down. Now let's see the option. Option A says that once every 3 years for high risk, 8 years for medium risk. This is wrong. Right, once every 2 years for high risk, 8 years for medium risk. Yes, correct. Obviously this is correct. Remember, KYC updation is to be done every 2 years for high risk customer, every 8 years for medium risk customer, and 10 years for low risk customer. Option B is the correct answer, right? Please remember it. Now let's see the next question. List MCQ that we have for non face to face customer. It is regarding the non face to face customer. So the question is how to handle the high risk associated with the non face to face customer. You can see which of the following is not required to mitigate high risk for the non face to face customer. Not required. So remember, I have highlighted the not required. Friends, let us first understand this. So first let's understand what this non face to face customer are. You see this word non face to face customer, what does it mean? See, these are people who open account or do transaction remotely without physically visiting the bank. So they don't visit the bank, they remotely open the account. They open the account or do transaction remotely without physically visiting the bank. While this is super convenient, it also comes with higher risk. Bank must follow a strict measure to ensure that everything is legitimate. Let's see the option. Option A says certification of all the document to be insisted upon. So this is absolutely essential. Bank need to verify that the document provided are real. Think of it as security check, right? This is required, right? Option B says obtaining additional document if necessary. Correct again. If the bank feels that something is unclear, they might ask for extra document to make sure everything is in order. So this is also correct. Then allowing the first payment to be made in cash at the branch. Yes. No, this is big no, because allowing cash payment from the non face to face customer could lead to money laundering or fraud. Instead, the first payment must come from another bank account that already follow the KYC norm. This ensures a safe and moral traceable process. So this is a big no. For cross-border customers, certification of document or introduction by a regulatory third party with adequate KYC system. So this is a must, because for customer outside the country, their documents should be certified by a trusted and regulated third party. It is like having a referee who vouches for their identity. So this is correct. So the question was which is not required to mitigate higher risk for non face-to-face customer. So option number C is not required, right? So let's recap. First thing, certification of all the document, essential. Additional document, sometime necessary. First payment in cash, no, not allowed. Cross-border customer must be verified by trusted party, right? Remember, cash payment for non face-to-face customer are like a red flag in banking. Always look for traceable method, right? I hope this question is clear now. So friends, if you want a study material related to the AML KYC, we have an app called JIB and CIB Made Simple app. In the description section you will get the link of the app. In that app I have provided AML KYC per unit MCQs, per unit theory portion, per unit previous year question. All these are available in just 200 rupees. So you get the link of the course in the description section also. Just click on that link and you can make the purchase regarding this particular course, right? Now let's see the next question. The next question is in the front of your screen. This question is based on the Vienna Convention 1988, right? Vienna Convention which happened in 1988. This question is regarding that. Let's go through the question. So it is about key measures from the Vienna Convention of 1988. It is about preventing drug trafficking and stopping the flow of illegal money. This topic is exam relevant, so stick around as I simplify it for you. Let's jump into. Question is which one of the following is not a measure mandated by the Vienna Convention? Not a measure. Question is regarding not. Okay. Now Vienna Convention, it happened in 1988. So it was a global agreement focused on fighting drug trafficking, right? Drug trafficking and its financial impact. It listed specific measures to help country crack down on this illegal activity. but not all actions were allowed. Let me explain. So option A says that declaring the conversion or transfer of property from drug trafficking as an offense. See, this is correct. The convention wanted all nations to treat money or property made through drug trafficking as illegal and take a strong action against it. Yes, correct. Option B says that concealing the illicit origin, transfer or movement of property derived from drug trafficking as an offense. See, absolutely right again. The idea was to make it a crime to hide when illegal money or property came from or how it is being moved around. Now let's see the option number C. What option number C says? Option number C says that establishing measure to legalize fund derived from drug trafficking. What do you think? So this one is not true, because the convention was all about stopping the flow of illegal money. This convention was all about stopping the flow of illegal money, right? Not making it legal. So any attempt to legitimize fund from drug trafficking was strictly against its objective. And option D says providing mutual legal assistance, transfer of proceedings and international cooperation. See, this is a spot on. The convention emphasized teamwork among countries. It encouraged sharing legal resources, transferring cases and cooperating internationally to tackle drug trafficking. Right? So what do you think is the correct answer? Option number C is incorrect, right? The question is regarding incorrect. So let us recap what we have seen, that declaring conversion or transfer of property mandated, right? Declaring the conversion or transfer of property, this was mandated. Then concealing illicit origin or movement of fund, it also mandated. Then legalizing fund from drug trafficking, absolutely not allowed. How can you legalize? Suppose fund you are getting from drug trafficking, how can you legalize that? You can't do that, right? Option D. Now friends, the next question you can see is based on the Egmont Group of Financial Intelligence Unit or FIU. So question is, which of the following is not an objective of the Egmont Group of Financial Intelligence Unit? So let's see the option. So options are to promote the development of FIU globally, to cooperate in information exchange, training and sharing, right? Option C says to establish mandatory regulation, and option D says to publish operational guidelines. Let's see the option. So first of all, let me tell you that this Egmont Group is an international organization that helps financial intelligence unit, that is FIU, around the world work together to fight crimes like money laundering. Now let's look at this tricky MCQ and solve it together. Question is, which of the following is not an objective? Right, so let's see the option A. It says that to promote the development of financial intelligence unit globally. Yes, obviously this is correct. You know, the Egmont Group focus on building and supporting FIU worldwide to make them more effective. Option B says that to cooperate in information exchange, training and sharing expertise. Yes, this is also correct. Sharing information, training members and exchanging expertise are the key objectives of the Egmont Group to help fight financial crimes. Then option C says to establish mandatory regulation for financial institution to participate in money laundering activity. Yes, this is clearly wrong. You know, the Egmont Group exists to stop financial crime like money laundering, not encourage them. Here it is written to encourage, to establish mandatory regulation for financial institution to participate. No. Nobody encourage it, right? Option D say to publish operational guidance for FIU, Egmont Charter and Egmont Principle for Information Exchange. Yes, this is correct too. Egmont Group provide guideline and principle for FIU to follow in their operation. So here is a quick recap. Promoting FIU globally, true. Cooperation and sharing expertise, this is also true. Encouraging money laundering, absolutely not. And publishing guideline for FIU, this is correct. Right, and that is the Egmont Group in nutshell. I hope this clear your concept. What is Egmont Group? Now let's see the next question that we have. It is regarding the multiple tier of account. So what is multiple tier of account? Let's discuss. So friends, question is, what does multi-tier structuring aim to achieve? What is the primary objective of using a multiple tier account structure in financial transaction? Options are simplify the tracking of fund for regulatory authority, to pass funds through multiple accounts by splitting them at each stage, making tracking difficult. Option C says to ensure direct and transparent fund transfer between account, to reduce the number of accounts involved in financial transaction. So what is your guess? Let's decode each option. Option A says simplify tracking by making fund easier to trace. This is incorrect. You know, multi-tier structuring is used to complicate things, not make things simpler. Option B says to pass fund through multiple accounts by splitting them, making tracing difficult. Exactly correct. Because you know, the idea behind multi-tier structuring is to move money across various accounts in a small chunk, so that the tracing the origin of the fund become almost impossible. Option C, to ensure direct and transparent fund transfer between accounts. So this is red cross. Why? Because the method is designed to make transaction flow as opaque and confusing as possible. Option D say to reduce the number of accounts involved in financial transaction. This is also incorrect, because multi-tier structuring increases the number of accounts involved, making it harder for investigator to follow the money trail. That is why option number B is correct. So here's a quick recap. Option A, simplified tracking, no. Option B, pass fund through multiple account, yes. Option C, create transparency, no. Option D, reduce account involved, no. Now let's talk about the funnel account. Which of the following statement best describe the concept of funnel account? So what is the funnel account? Let's see the option. So first option is a bank account used for depositing illicit fund from multiple individual, usually in amount below the reporting threshold, and withdrawing them from distant location. Option B says a type of saving account that offer higher interest rate and tax benefit. Option C, an account where only one person can deposit and withdraw fund without any restriction. Option D, a government regulated account designed to track large transaction for anti-money laundering purpose. So option A says that a bank account used for this is regarding the funnel account. Best describe the funnel account. A bank account used for depositing illicit fund from multiple individual. So what do you think? Is it correct or incorrect? So see, this is absolutely correct. Funnel account are specifically designed for money laundering. People deposit a small amount of money into this account, small enough to avoid suspicion, and then the money is withdrawn from different location, making it hard to trace. So it deals with a small amount. First thing is that it deals with a small amount, right? It deals with a small amount. People deposit a small amount of money into this account, and small enough to avoid suspicion, and the money is withdrawn from different location. A small amount and different location. These are the two keyword you need to remember. A small amount and different location, right? So the money is withdrawn from different location, making it hard to trace. Now option B says a type of saving account that offer higher interest rate and tax benefit. See, this is incorrect because funnel account have nothing to do with saving or interest rate. They are used for illegal purpose, not for legitimate saving. Option C says an account where only one person can deposit and withdraw fund without any restriction. This is also incorrect. Funnel account involve multiple people depositing money, not just a single person. Option D says a government regulated account designed to track large transaction for anti-money laundering purpose. What do you think? So this option is also incorrect because funnel account are not government regulated. Clearly written government regulated. No. This is not government regulated account. Right. In fact, they are used to evade detection by authority. So here is a quick recap. Option A, yes, that is correct. Funnel account are for a small deposit and withdrawal across distant location. Option B, a type of saving account that offer higher interest rate and tax benefit. No, they are not saving account. Option C, an account where only one person can deposit. No, multiple people are involved, not only one person. Option D, government regulated. No, this is not regulated by government. So we can see option A is the correct here. Right, option A is the correct answer here. Now let's move over to the next question. Let's move to the next question. The next question, as you can see, this is the type of case study which has been asked in the previous year examination. Let's go through the case study. So the question is like a businessman Mr. X generate large amount of cash through illegal activity. To avoid suspicion, he deposit a small amount of this cash into multiple bank account under different name. Some of this money is even smuggled abroad and deposited in foreign bank where regulations are more lenient. Despite banking regulation on large cash deposit, Mr. X cleverly avoid detection and integrate his illicit fund into the financial system. So this is the case study. Now question is, which stage of the money laundering process is Mr. X engaging in? Placement, layering, integration or structuring. You know, these are the stages, and you must be clear with all the stages because question is asked every year from stages, right? So which stage is involving in? What do you think? First option say placement. Yes, absolutely correct. Placement is the first stage of money laundering. This is where illegal cash is introduced into the financial system. Mr. X deposit a small amount into multiple accounts locally and internationally, which makes it hard for authority to track the fund. So smuggling fund abroad is another classic placement technique. Right, so this is correct. Placement is correct. Layering. See, this is incorrect because layering happen after placement. First placement occur, then layering occur. So layering involve moving the money through a series of complex transactions. Right. So what do we do in layering? That we move the money through the series of complex transactions. Right. Series of complex transactions. So it involves moving the money through a series of complex transactions to obscure its illicit origin. So Mr. X has not started doing that yet. So this is incorrect. Integration also incorrect because integration is the final stage of money laundering where the laundered money is mixed with legitimate fund and used for legal investment. So what happened in integration, as the name itself suggests, laundered money is mixed with what? It is mixed with legitimate fund, right? So it is used for legal investment. So it is Mr. X is not at this stage yet. And option D says structuring. So structuring, this is incorrect as well. Structuring involves breaking large cash transaction into a smaller amount to avoid reporting threshold. So while Mr. X is depositing a small amount, he is also smuggling money abroad, which does not fit the definition of structuring entirely. So let's recap. So option A, placement, yes, that is the correct answer. Option B, layering, no, that is not the next stage. That is the next stage after placement. Integration, you know, this is also the last stage. And structuring, not quite. Mr. X action goes beyond structuring. So the key takeaway is that placement is the starting point of money laundering. It involves introducing illicit fund into the financial system, often through method like small deposit, smuggling, or using multiple account, right? So hopefully this concept is clear now. So we know what is a placement now. Let's move on to the next question. Everything is explained clearly in this particular PDF. This is available in our course. Now this is another scenario in front of you. So what is happening in the scenario? So let me share a story. Imagine a businessman, Mr. X, who earned tons of cash from illegal activity, right? Tons of cash from illegal activity. Say things that he should not be doing. Now he can't just walk into a bank and deposit all that cash, right? It will raise red flag with authority, right? So here is what he does. He deposits a small amount of money into multiple bank account under fake name to avoid suspicion, right? So then, to make it even trickier to trace, he smuggles some of his cash to foreign country where bank rules are more relaxed. Despite strict regulation, Mr. X cleverly dodges detection and sneaks his dirty money into the financial system. Sound like a movie, doesn't it? Now here is a question for you. Question is, which stage of the money laundering process is Mr. X engaging in and what technique is he using? Placement, layering, integration, or structuring? Similar question like the previous one, right? So obviously I think it is repeated. We have already discussed it is placement. So I think this question gets repeated. Now let's talk about the Hawala system. Let's talk about it, Hawala system. So friends, the question is in front of your screen. So question is, which of the following statement correctly describe the Hawala system? First, let me talk about what Hawala system actually is. Imagine you need to send money to someone in another country. So you are in India and you need to send money to US, someone in USA, okay? But you don't want to use traditional bank transfer. So you could go to a Hawala broker who had a network of other broker in the recipient country. Instead of a bank transfer, you hand over the money to one broker and the other broker delivers the fund to the person you are sending them to. What I am saying, that you could go to Hawala broker who had a network of other broker in the recipient country. So in India, you go to a Hawala broker and that particular broker has a recipient of broker in other country, in the recipient country. Instead of bank transfer, you hand over the money to one broker and the other broker delivers the fund to the person you are sending them to. Simple, right? But here is a catch. These transactions are not documented and there are no paper trail, right? So now let's look at the question based on this system. So first option, let's say that it is a regulated first option say it is a regulated system, a banking system that ensure all transactions are documented. No. See, this is incorrect because the Hawala system is not regulated by any government authority. There is no paper trail and no official monitoring, which is the opposite of a regulated banking system. Option B says that it operates outside government control, enabling undocumented deposit, withdrawal and fund transfer through a network of broker. Yes, correct. The Hawala system operates without any formal regulation or banking oversight. It is based purely on trust and a network of broker. So there is no paperwork, no documentation, no government monitoring. This make it an attractive option for people who want to transfer money secretly, but it also make it a system linked to illegal activity like money laundering and terrorist financing, right? So option B is correct. Option C says that it is a financial system where funds are transferred only within the same country, avoiding any cross-border transaction. No, this is wrong, right? So why? Because Hawala is not limited to domestic transaction. It is frequently used for cross-border transfer. Option D said it is primarily used for legal business transaction and leave a clear paper trail for tracking money movement. So while some might use it for legal purpose, the Hawala system does not leave a paper trail. In fact, it is often linked to illegal activity because of the anonymity it provides. So what we learned today, that Hawala system is an informal way of transferring money without any government oversight or formal documentation. So it operates through a broker who transfer fund across border, no paperwork or official record, making it nearly impossible to track. While it can be used for legal purpose, it is often associated with illegal activities like money laundering. Right? I hope this explanation helped you to understand the basic concept regarding the Hawala system. Now let's move over to the next question. So the next question is Watergate scandal and money laundering. Let's talk about. Question is, when was the term money laundering first used in the press and in what context? Very good question. So when was the term money laundering used? Let's rewind to the early 1970s. Imagine a major political scandal unfolding in United States. In 1972, something huge was happening and the term money laundering was making its first appearance in the media. But how did it all begin? Let's look at the question based on this. So we have the question here. Let's go through the option. Option A says that in 1988 by the New York Times in relation to the Iran-Contra affair. No. While the term money laundering was used in 1980s, it wasn't first used in 1988. It is certainly not in connection with the Iran-Contra affair. So option A is wrong. Option B says in 1972 by the Guardian in connection with the Watergate scandal. Yes, correct. Absolutely. The term money laundering was first introduced in public in 1972 by the British newspaper The Guardian. It was used in the relation to the Watergate scandal, one of the biggest political scandal in US history. This scandal ultimately led to the resignation of the US President Richard Nixon. So it was so used that the US President had to resign. Richard Nixon has to resign. In 1955 by the Washington Post regarding the Enron financial fraud. No, this is also incorrect, because the Enron financial fraud happened much later in 2001 by time during the investigation of 9/11 attack. No, this is also wrong. So hopefully you have understood that it was first time used in the 1972 by the Guardian in connection with the Watergate scandal by the US. Now there is some question on OVD. OVD means officially valid document. Which of the following is not considered an OVD for identity and address verification in India? Passport, driving license, Aadhaar issued by private company, and voter identity card. So which is not an OVD for identity and address verification? Very good question. So in India, OVD, this obviously valid document, is a government issued document that is used for identity and address verification. But when it came to Aadhaar card, only those issued by the UIDAI. Here you can see Aadhaar card issued by private company. This is wrong, because Aadhaar card which is issued by UIDAI, right, or NPR, National Population Register, right, they are valid for verification purpose. Aadhaar card issued by private company are not valid. That is why option number C is incorrect. Right, C is correct. Passport is valid. Right, passport is government issued OVD. Driving license is also valid. This is another government issued OVD. Aadhaar card issued by private company. This is wrong. And voter identity card is also wrong. This is issued by the Election Commission of India and is considered a valid OVD. Right. So what we have seen, the option number C is wrong. Friends, as you can see, we have several other questions, but we will cover it in our paid course. So the rest question you will get in our paid course. If you want to enroll, these are the OVD available. So if you want to enroll in our paid course, you can WhatsApp me on this particular number. Either WhatsApp me on this particular number, or you can, in the description section I have provided link of the course. You can get through that particular course, and do join our Telegram channel for more update related to this examination. So that's all for today. These are the questions which are more and more available. Thank you.